Welcome to our long podcast on international banking. Dr. Yanis will take you through the key elements of the regulation of financial institutions and the operations of banking. Have a look around the channel for more topics similar to this and great resources for law students. We are starting right away. Sit back and relax while Dr. Yanis takes you on this journey.
EU law is useful on an international level because the core of find is either in the United States or in Europe. Therefore, even if you're coming from a third country, it's likely that they will be doing business with one of the major banks or financial centers established here. So you will need to know how these centers are regulated and under which legal framework they're operating in order to understand if you have to attend on what they need to do. Now, there's a difference between financial architecture and regulation in the United States and what's happening in Europe. Our reference point, of course, is Europe because we're here. The logic, even though the tools might differ and the architecture might differ, the logic in many places is common because there is an attempt at global harmonization in the way that banks are regulated and for issues of systemic stability and so on. Some of the sources of law are international in nature anyway, so what comes out of Basel, for instance, in terms of how the banking system is made more secure. These are rules and recommendations that then find expression internationally in consistent ways. Nobody goes to a foreign country in order to study the local laws of that country in isolation to everything else. So you get there is of course a national anchor or a European anchor as we have in this case, but you can take from that knowledge that then is applicable on a global basis so you can help deal with clients or understand how the things work on a global level. One of the issues that we have is that if you're coming from overseas and you don't have a degree from a European university, or a law degree in any case, you might not be very familiar with the structure of the European rules and how everything is supposed to work within here. So part of what I do for this initial class is just to give you guys a little bit of a summary of how EU law is supposed to operate, so then you understand where things. English universities, we teach EU law, but we try to do it in a covert way, not to bang on about it. Historically, right, you told students that this was a class on EU law, everybody fell asleep instantly, because it was as if you told them, this is like some foreign stuff now, and everybody was like, yeah, what do we care? And this has been a consistent experience from when I was a student in the mid-90s all the way up till now. At least now people have got an excuse. So why do we have to do EU law? It's irrelevant now, which of course it isn't for the reason that I explained. Since everything gets incorporated, now you have to know about it even more than before because now it's going to be domestically enforced as opposed to anything else. But people have always had this aversion to EU law. So we find that even when we tell that stuff to students who have a degree from an English university, they still behave as if they're listening to it for the first time ever. How does the European Union work and how does the law operate within that system that is relevant to what we're doing here? The core architecture of EU law is placed in the treaties. And there's a lot of talk about this, about how a series of international treaties system that then gets its own life and operates individually on something that looks like a federation but is not quite a federation. So in the United States, it's easier to explain these things because you say at some point all these guys decided to get together as one nation state, and in order for that nation state to come together within a legal environment, they've created federal law, which is created in a specific way and then enforced through federal courts. But then you've got subsumed legal systems that have to do with the various territories within the United States. You could say the same about Europe, but because Europe is not truly federalized, there are a lot of conflicts and mismatches in these different domains. But the core of EU law has its basis in the treaty. So the main treaty is the Treaty of Rome that founded at the end of the 1950s, founded the European Community as it was at the time. And that created a series of institutions that are the core institutions of what was the European community at the time, and it said how these institutions relate with each other, relate to the national governments and national law, relate to individuals and corporations, and what effects they've got in the marketplace. Of course, as things moved on and as more countries joined the European community and law matured and became more, the situation became more complex but also more harmonized and more consistent, you began to have additional things. So the two key points that you've got in the institutional evolution of the EU, one is the Treaty of Rome at the beginning that establishes the European community, and then you've got in 1992 the Maastricht Treaty that establishes the European Union, that brings together the coordinated set of institutions and legal instruments that we have today. You have to get used to the names, because every time you get something new or a new treaty or a treaty amendment, very often they renumber the previous articles, so the content stays the same, but they change the numbering, or they change the name of what it's called. And then if you pick up an old textbook, you don't have a clue what's happening anymore. So this was a big deal when I was a student, because it was relatively soon after the Treaty of Maastricht that everything had been renumbered and redone, and everybody was in a panic about it. And even kind of 5 years down the line, we were being taught the old numbers and the old references and then the new ones. To put them down now in a sequence, you've got the Treaty on the European Union is one piece that comes out of the stuff that happened in Maastricht. You've got the Treaty of the Functioning of the European Union, which incorporates the basic principles from the Treaty of Rome. That was they call them something else so we can tell them apart. I don't know. So one is the TEU, Treaty on European Union. The other one is TFEU, Treaty on the Functioning of the European Union. These two things. And you got a third one, the Charter of Fundamental Rights. Because at some point, the European Union as a whole acceded to the European Convention of Human Rights and incorporated the system of human rights protection and all of that entails in European law as a key component. So the three fundamental constitutional documents, if you want to call them that, are those. What came from the original treaty in Rome, what came from Maastricht, and now the Charter of Fundamental Rights. How do these affect outcomes in terms of legal making? So you create new laws, or you create new procedures, or you create new stuff that people need to comply with. How does that work? The two creating law at European Union level, one is through regulations and the other one is through directives. Now, what's the difference between them? Again, the language in itself means nothing. So you need to look into the definitions of these things to figure out what they're meant to do. The regulations are things that are created at EU level that are directly have a direct effect. They're directly enforceable everywhere for everybody. So if something is created as a regulation and it says from that point onwards, this comes into operation, then everybody across the whole union is obligated to respect this because this is an expression of the law now. If it's not a regulation and it's a directive, this is a command from the European system to national governments to legislate at national level in order to achieve the objectives specified in the directive. So regulations have direct application. They create direct consequences for people and businesses and everybody. Directives do not have such an immediate impact because they need to be implemented by the national governments in a way that matches the rest of the legal system. And the reason why this is done is because you go all these countries that are part of the European Union, however, they all maintain their own national identity, national legal systems, and all the rest of it. Some stuff can be done at the core level that affects everybody equally, but some stuff cannot be done unless it links up with the rest of national law. Otherwise, it creates too many inconsistent outcomes. So the process of lawmaking through the directive is that the EU says, we decided we want to do something, so you guys, this is what we're trying to do. You guys take it and make sure that you implement it in national law appropriately. So everybody ends up doing the same thing, but it's done in a sort of organic, smooth way that it doesn't create conflicts within the various national legal systems. Whether that means for individuals that you can immediately rely on a directive to force somebody to do something or not, this is a big discussion that goes into EU law. That's not for us at the moment. For us, the core structure. So you got these three components of the treaties, and then you get all this lawmaking that comes either through regulations or it comes through directives. Now, do the national governments do a good job in transposing these directives into national law? No, they don't. Because most of the time they just translate it and plop it right in. And the British have been famous for doing exactly that, of taking something that is a directive and passing a statutory instrument that gives it effect in English law and doing it straight away, and nobody cares whether it is in or the other legislation, which has caused all sorts of problems down the line. Key example of this is consumer protection. There are a lot of stuff that had to do with consumer protection. They came as a directive, so the EU said, we're all going to try and do this now to improve consumer protection across the Union. You guys take it and incorporate it into your legal systems. The Brits took it, plop, they stuck it in there in ways that created all sorts of inconsistencies with existing legislation in here, which then gave jobs to academics for the next 15 years to keep banging on about it, how the system now is clunky and doesn't work. And finally, after years of banging on about it, 20 years actually, because the first consumer directive was 96. We ended up in 2016 with the Consumer Rights Act that tries to fix the inconsistencies and the differences between the two systems coming together. So if it is to fix some kind of minor language inconsistencies in consumer protection instruments, right? Imagine how many millions of years it's gonna take to deal with all the legal changes involved in Brexit across all sectors simultaneously. But then again, it's a wonderful time to be a lawyer. We know roughly how the EU system is structured and where the rules come from and the mechanism through which they come. Have you had enough already? It's time to take a short break. Pause the recording, take a few minutes, and then come back and continue for the rest of the lecture. What happens with financial regulation specifically? Now, financial regulation has been a problem because being engaged in finance is not the same as being engaged in any other sort of business. The obvious reason for this is providers getting into trouble are much more serious than commercial providers getting into trouble. You do not want, for instance, a bank that takes people's deposits to go bust and for people to lose their money. You want stability enough to deposit their money safely, that they can get loans and credit when they need to expand their business. This is the lifeline of a modern economy, and as such, it is something that has always been controlled by the state to make sure that it is properly and carefully done and to avoid instances of crisis. This doesn't mean that crisis does not occur in a periodic kind of circular way, but the argument is that it would have been way worse if you didn't have some sort of governmental or regulatory control in these domains, right? Because states are very concerned about the stability and health of their banking systems and of their financial instruments within their own states. They've always been very unhappy with giving this regulatory provision to somebody else outside their borders. Progress in harmonization of standards has moved slowly in banking and finance. So you've got other areas of activity within the European Union that harmonized a lot earlier than banking and finance. And the reason is exactly this. Each state wanted to be in control of its own money supply, of its own banking system, and to be the one that gives the licenses and approvals or chases after people who don't do a good job. and they did not want to subcontract this to somebody else. However, once you have the European Union, and you got a system that is supposed to create like a massive economy that operates in a coordinated way, you cannot have a massive coordinated economy and a common sphere of activity without some sort of common control over banking and finance. Because the whole idea of a unit commercial space and a unitary business space is that you have this ability to move money around. You've got this ability to get credit from a variety of places. And compartmentalizing the money aspect from the commercial aspect would have been an inhibitor to the union as a truly operational structure. So you started having attempts at bringing these things together. So you got a first banking directive. This is already something in the 70s. That is a process between states in the European community as it was at the time to recognize each other's regulatory standards. So the first step into a process of integrating a market is to start to recognize that the other authorities actually know what they're doing and you respect their decisions, or you respect to do them their work, and you don't second guess their decisions. So somebody who has regulatory authorizations from one end, these are recognized someplace else. But of course, this was done in a very crude way that didn't actually open up the market to providers from different states at that point. That's why you had the second banking directive, which created the European passport that is very important from the point that we go from the original incarnation of the Union of basically as a trade bloc that was meant to reduce barriers to allow the countries within the European community to trade and organize themselves in commercial manners in an easier way, right, than doing it simply in the easier way, right, than doing it simply in the kind of cross-border sense when it was done before. When you moved to Maastricht and the creation of the European Union, you were trying to create a truly single space where everything happens as if it would happen within the same nation state. The key components, and this is kind of relevant to the discussions that you see in the press now, and the key components of the European Union are the four freedoms. The freedom of movement, but for what? Goods, services, people, and capital. If you're trying to create a unitary space, then you need to ensure that things can move about, but not only things, the physical goods, that people that come with them, services, not services that are linked to the goods, or services that are linked to the people, or services that can be offered remotely, across borders, and crucially that the money can move. And these things are interlinked, which creates a significant amount of trouble if you find yourself in a situation that you're trying to undo this dynamic to disentangle these various freedoms. So what's happening at the moment with Brexit is a debate as to who would want to be completely outside this and be a third country in relation to the European Union. And, there's an attempt to figure out what that entails exactly. So how different would it be for commercial and financial activity if the UK was dealt in the same way as Canada or Australia or New Zealand or the United States, right, as opposed to a European Union member? But also there's been a debate as to, can you segregate between these things and arrive at an arrangement that works in a different way? It has been very difficult to arrive at different arrangements because these four freedoms are supposed to operate in conjunction. Perhaps the one that is distinct from this, one could say, is the freedom of people to move. So you can have a debate as to whether freedom of movement for people, component for business to continue to operate in the way that it does. So the EU takes the position that these four come together as a package, and it's a matter of principle that they cannot be disentangled. But from a technical point of view, freedom of movement for people, in the sense of immigration control, could be structured in a different way. And services and capital, however, cannot be disentangled. And this is a very significant problem. This is not really something that can be successfully done in a modern economy and with the products that we trade now. many products contain elements of services, or they are accessories to services, and the other way to services, and the other way around. So an attempt to disentangle goods, like the physical forms of goods, from the service is a very difficult thing to achieve in a modern trade environment. Never mind the fact that Britain was a leader in the export of services, not goods. So why would you choose to prioritize goods as the services when actually the services part of the industry is a much bigger component of the economy than goods? Nobody quite understands. But even if you wanted to prioritize goods for that, for some reason, that you're a major manufacturer like China or something, it is it is now very difficult to disentangle the goods from the service, and certainly it is very difficult to disentangle it from the capital. Because freedom of capital means a variety of things, but it also means simply being able to take your money out. It has to do with money transfers, and the ability to engage in business in another country, be subject to taxes or charges and things over there, but then repatriate your profits, changing them within currencies and all of that stuff. You would not necessarily want to go to a country that then you cannot repatriate the profit. So the idea of capital controls, for instance, or prohibitions in changing from one currency to the other, or the prohibitions in taking money out of a country, these are unknown in a modern developed economy context, but can actually make a very significant difference. So on vacation to Morocco, you cannot you cannot come out with your pockets stuffed of the local currency. You're not allowed to export it. Yeah. Or you invest in China, you don't have free convertibility, meaning that you cannot take all your money out in the way that you cannot take out all your profits, even in places like India and so on. So you need to be, this is something to think about. The disruption that it causes to think about organizing economic activity without the freedom of capital. So one of the things that's happening now that's relevant to us in this class is that from the four freedoms, the more relevant to banking and finance are obviously services and capital. And what happened as there was an attempt to harmonize the market for banking and finance and to have a truly unitary banking system to support a unitary special market that was being created in the EU, is that they came up with the idea of the European passport, which is a complete system of recognition of other people's regulatory requirements. So the idea is that if you're a bank that has established in one of the member states, then the others will not second guess your status. So if you're a bank that established in the UK, you have the ability to sell your products and services to everybody across the union without needing additional authorizations about each country that you operate. A British bank could open branches across the union and engage in regulated activity. Regulated activity is the taking of deposits, making of loans, and all of that stuff. You want examples from the high street, right? There's a Santander UK, but there's also the Spanish Santander that has a branch in the UK. If you open a subsidiary, meaning that a full new entity, then you would need to establish in the country that you're going, and you might want to do this for a variety of reasons. But you can also operate a branch. So the Spanish Santander can operate in London and have its clients and its accounts and no problems at all without needing to register with the UK institutions. It does this exercising its European, one of the older UK banks a few years ago, because they wanted to run a different consumer-focused thing over here. The savings account for years has been the one offered by the Bank of Cyprus, for instance, which sounds great if you don't know the history of the Bank of Cyprus. But the fact is that this is a bank that runs consumer finance here. So you can buy their products here, no problem. Passport is that means you've established somewhere, you did your paperwork, you got your license, you're free to do business across the union without getting additional authorizations, and the money can come and go without any problems. Meaning that you can transfer or you can run funds from here and the money can come and go, the funds could be placed someplace else. Why is this significant? It is significant because it has to do with Again, the regulatory system that obligates banks to move the money around in specific ways. There's all this business about capital buffers, the money that the bank needs to keep aside as security money and all of these things. This is very significant. If you have a bank established in Greece, it is regulated by the Bank of Greece. Then the Bank of Greece will determine what is appropriate security capital to be, not over there physically, but they will determine what sorts of investments the bank is allowed to make for different types of capital. All these kind of tier 1, 2, 3 capital structures that link up with international rules that come out of Basel as to what is a safe way for a bank to run itself, right? That means that the bank will need to hold some capital to protect it, but it holds it in a specific fund over there. If it needed to re-establish a presence under a different regulator, for example here, it would be subject to the same requirements, meaning that the banks cannot lose money, because the bank then would need to have some money set aside in Greece, and then some money set aside here, and then some money set aside in Ireland. So that reduces the available money and it reduces the types of investments that the bank can make. So all these things have a cost. They have a cost for the bank in what sort of investment make and how it distributes its capital. If you're crossing borders and you're subject to controls and authorizations, there will be some cost every time the money crosses borders. If you want a simple example, I now send money to my European accounts in banks in Europe, right? I have a Euro account, British bank. When I send money from my Euro account here to a Euro account in Europe, do you know how much I paid in commission? Nothing. I don't pay anything. Because it's called a SEPA transfer. It's like a single European payments area transfer. So long as you transfer money within the European Union account to a Euro account, there is no charge. It is the same as me transferring sterling from a NatWest account to a Santander account here in the UK. But the reason why this is happening is the passport. If you desegregate the space, and if you did not have this ability, you would have costs, both in the way that you structure stuff and in the actual transactions. You might even not have the ability to do certain things. So now you can offer financial services across borders, right? Somebody can take a loan, or they can make a deposit or buy a bond. You cannot do this. I cannot buy a bond now from a Kuwaiti bank. I cannot as a consumer here. But I can go to the post office and I can buy a fixed investment from the post office. I can put my money in an ISA at the post office. That's held by the post office banks regulated by the Bank of Ireland. It's a foreign bank, the post office, but it does consumer finance here. Okay, so you lose the ability to do all that stuff, and that brings up costs everywhere. And you might not even allowed to do it. So they might not allow you for certain types of financial products if you're not within the remit of a particular regulator, then you're simply not allowed to do it, which is a big debate about euro clearing and payments and where certain funds are positioned. And Europe has said that we'll see how things go, but you should not assume that you'll be allowed to operate euro clearing, so to have accounts and have euro run through those accounts because you're outside the EU. You have to redenominate in a different currency because there's massive costs involved in that. This is the consequences of having a regulatory framework that tries to harmonize across borders. So we're not saying that these borders do not exist anymore. They exist, but the regulators work very closely together in a way that they recognize each other's standards, and then it allows this to the consumers. The regulator does see a difference at things that are going across borders, but the consumer doesn't. So you don't care whether you're opening a bank account or you got a bond or you opened a savings account. You don't care where the bank's coming from because it's in the high street, right? Are you particularly concerned that the post office is in Ireland or the UK? Most people are not. People my generation are, because we saw that when the banks failed, that you needed today to get your money back from the regulator, it did make a difference whether it was the British regulator or the Irish one, because the Irish one was bust. The Irish one was bust. So if the whole country has gone bankrupt, then that's the problem. But for everyday transactions, it doesn't matter. These things have moved on. So the key structure was, as we said, with the creation of the EU and the four freedoms, and what this meant in banking and finance, what this meant in banking and finance in terms of the financial passport. But things have moved on, and they become more complex as time passes by, both because the system is trying to be even more integrated and better. I mean, there's new stuff happening all the time. The fact that now you can do these kind of intra-euro transfers, this is new. Up till last year, there was a charge involved. Yeah. The fact that now you can use your credit cards everywhere, and the providers are not allowed to differentiate between different types of payment is significant, because now you can use your credit card, EasyJet flight, and they won't charge you 3% extra. Well, before you could only, they said this is the price if you book your flight, you pay for it with a debit card, and there's a different price if you pay it with a credit card. So all these things are going because the system evolves and becomes more and more integrated and perhaps a little bit more demanding of financial providers. And you had a process that runs alongside the actual process of regulation. Every time that you got a regulatory framework set up that requires certain things, underneath this, or that requires certain things, underneath this or above this, if you want, you got a constant debate as to how the rules should change and evolve and improve in the future. So you get long-term processes of form. So when they set up the first banking directive, then they engaged in a kind of decade-long discussion. So these normally get named after some kind of major guy who's heading the thing. So you had the Lamfalussy report that was about improving the system of banking and regulation within the EU. Then you have the De La Rosière report, which is another one in bringing things forward. So one was before the crisis, one was after. Before the crisis, one was after. After the financial crisis, a lot of things happened in improving the regulatory framework, in ensuring that things are more secure for the future. Yeah, because obviously the financial crisis in 2008, an illustration that something went wrong somewhere, because you have a system that was relatively well integrated and well regulated, yet it created a major disaster. And the regulation of the system, instead of ensuring stability, it had created a system where a risk traveled from one place to the next and contaminated the whole system. So this was certainly something that needed to be looked at. The process of reform that came after 2008, after the crisis, was about fixing the things that went wrong, that have been identified in the crisis, so then this crisis does not occur again. And you had a regulatory system that became more complex and more burdensome. That's why all my banker friends are complaining about it. But the financial industry is the type of animal that it needs to be constrained in order not to cause doubt. So of course everybody understands that more rules and more regulations and more paperwork has a cost, and it reduces the ability of business to do business, and it produces less money. However, on the other hand, this is counterbalanced by more stability, because things that are super dynamic and make super amounts of money also have the capacity to blow, and the consequences of these blow-ups are usually suffered not by the people sitting on the bomb, but who set it off, but the people around it. Yeah. And what has happened during the crisis is very much that the financial system imploded and the banks went bankrupt. However, the costs of dealing with that got passed on to everyday people out there as the states tried to sort of consolidate and raise the money in order to keep the banking system up. A rather unsatisfactory situation. So what you had after that was some recognition that we're going to need a less dynamic and less perhaps banking system, but one that is less prone to causing such disasters that then flow down and hurt people everywhere else that actually have nothing to do with the banking system. So you're going to see in the progression of classes that we're going to have how this system of regulation has created both for banks and financial markets, and what this means now in the relationship of the businesses to each other, but also the relationship of the businesses to their customers and the relationship of the state to those businesses. This is our second class. So we're going to talk about financial markets. So this is the first thing. Let's think a little bit about types of people who are involved in financial markets. I'm guessing having a look at who the players are in these markets and what everybody's supposed to get out of it, the types of products that you've got circulating is a good place to start. People need to raise money. Now, why do people need to raise money? Because if you get the money from somebody quickly, then you can invest it and produce something that then increases your capacity, increases your outputs much, much quicker than generating that money on your own. So if you want to start from companies, for instance, why is it necessary? I mean, you could argue that it's not necessary to borrow money. You can just retain profits, and out of the profits that you make, then get something, right? So if a company is trading successfully, there's profit accumulating. That profit at the end of the year could be reinvested by getting better equipment, hiring more employees, getting larger premises, or finding into new markets, or investing in IT, or any of these things. But you're going to have to wait quite a long time till you've gathered all that money to buy something. I don't know. How do you guys buy stuff? You can kind of save and then buy that iPhone 3 years down the line. Or you get your dad to buy it, but that's not really borrowing, yeah? Or you can get it with your credit card right now and then pay in installments. So there might be some interest involved, or might not be. I mean, some shops were offering interest-free repayments. Or you get a car, for instance. How do you buy a car? You can either save, or you can get the car with the financing. It might have some interest or not. I mean, I got my car with a 0% finance. So put some money up front, and then the rest I was repaying. And the total cost at the end was exactly the same. So why not? Instead of waiting for another year or two or I don't know, a few months to get the money, then I did it that way, so I had the car faster. So the whole idea is that you don't have to borrow in order to do stuff, but borrowing accelerates the process. A company that borrows the money will be able to engage in all this investment, and if it goes well, it's going to be way more profitable at the end of the year. What the financial analyst would help you to do in this case is to find the right balance between how much money you're borrowing, how much you're repaying, and what is the sort of profit expectation that you've got. So if you're borrowing that money to reinvest in the business, this is going to increase your profitability. It needs to increase it enough to allow you to repay the loan with the interest attached and living in a better position that you would have been if you were doing it organically or very slowly by saving them. Because of course, if you are to borrow and then not make any additional profits, then it leaves you worse off. It could also happen that if the rate of interest is very high, then it will leave you worse off. So the rate at which you're borrowing it is linked, apparently the number is linked very crucial from the plan, for the business plan that you have. Because it's not based on vague assumptions that, we're going to make a better website. So you need to think about how a better website would help you increase the client base, and then have a projection as to how many more things you're going to sell. That it makes sense. So that's how you can work it out. But it's complex. And this is not the job of the lawyer. This would be the job of the finance analyst, will be a calculus to do these projections for you. And then the lawyers will find the likelihood to express to the consultants. Because also the way in which you repay will be important, right? If I'm going to borrow money, and then you would repay either monthly or annual, or whatever, you could repay just the interest for a period, and then pay the interest and the amount that you got. You could be paying the amount and interest from the beginning or the other way around. Think about a mortgage or something like that. So there are multiple ways in which you can get money to buy a house. and that the payments are structured in different ways according to Puerto Rico. So one thing to know is that the longer it takes for the repayments and the smaller the amounts smaller and they go on for longer, the interest and the overall cost is going to be higher. And actually, these courses, if you look at the mortgage score or hobby, the total foundation is staying, right? Because you borrowing the house that you're getting is say 500,000, 600,000 pounds. And if you look at the total cost of the product with all charges and all the interest included over the 25 years that you have to repay, in the end, your amount is over a million. So if you end up paying double, but of course, I mean, it is very expensive, but it's still affordable. Could be affordable. Really, what you're interested in is the monthly rebate. And you're not going to say, why am I buying something for 600 then I'm repaying $1 million? You're going to say, you're never going to be able to do this. So the only way to do this is. And so, stuff that happen, okay, corporate loans for investment, and not that makes sense, of course, okay? But these are the sort of calculations that one will go. And it's not only corporate, it's also the state, right? The state in its various expressions. I mean, the government, the central government, but also local authorities and municipalities and so on, they borrow. Yes, why would the state need to borrow money? It could be that they are planning some big infrastructure project, like a government could borrow money because they want to do something. So they've got a plan of it. It costs money. So they either give it as concession to companies to build and then operate, and it works like that. Or if they want to build it themselves, they will borrow the money, engage in the investment, and then hope to repay it in the future somehow. But the crucial reason why governments borrow is not that. It's because they run a deficit. They just cannot keep going. So the majority of governments are running a budget deficit, which means that the amount that they bring in taxes and duties and tariffs and customs on a monthly basis are not enough to cover their expenditure. So this creates an ongoing need to borrow in order to be able to balance the books, which of course increases state debt that then needs to be serviced somehow. Even governments that have a balanced budget, they still need to borrow money because they're still paying off all their debts. So that's why you can have a primary surplus, as they say, that your balance is budget. So your budget is balanced. So whatever you take in from taxes and stuff is enough for you to make your payments. But if you calculate interest on former loans, you're in the red. So you need to borrow money to be able to make those repayments. So that's an ongoing thing, which is normal, okay? I mean, there's no country in the world, and no kind of municipality in the world that doesn't need to borrow money for a variety of reasons. However, this creates a demand, and it's got all these people. You've got corporate entities, you've got state entities in national and local level that need to find the money. They're trying to borrow money all. There are other people, I mean, you could have international development banks, international institutions, aid institutions that also need to generate money or need to borrow it from somewhere in order to put it to use according to what they're now. How do you actually borrow that money? Now, this depends on who you are, really. A company can raise money in two ways. One of it is get loans from another institution, from a bank, or even if it is a bank, then from another banking institution. One idea is to get loans. Another idea is to sell shares. Right? So one of the primary methods in which companies get money is by selling to the public. Listed in the stock market. I mean, normally you've got public companies listed in the stock market. All the banking institutions operate like that. And then you raise the money through the public, and then you put it to use. So you can either issue shares or you can borrow money from somebody, but you can also issue debt. So you can sell debt. And the way this is done is that you create, it's a way to get loans from other people. You have a piece of paper that says, you give me the money now, I give you your money back in a day. So if you're making a savings investment in the form of a bond or a fixed term product, this is what happens, right? You lock your money You give your money to the bank holds it for a period of time, then it returns it to you with interest. So this is another form of borrowing. It can be done by banks, but it can be done by corporates as well. Corporates very frequently issue debt. So you can go buy a bond from one of the auto manufacturers, you can buy it from wherever you want. So these are all mechanisms that you can actually get the money in. The states, they don't issue shares, obviously, but they issue bonds, right? The treasury bills, as they call them in the States. Here you can buy, they're called national savings bonds, what are they called? But it's called national savings, and you can buy them at the post office. That's the main difference between private institutions, like a company, for instance, and a state. A state will operate in the bond markets with various types of debt that they issue. A corporate has the capacity to both issue debt and to sell shares, so it's a bit more flexible, obviously. Now, shares themselves have got particular legal connotations, and there are some stuff that you can follow up as the courts have discussed the idea of a share and what it means as a property interest. And this is why you've got this case reference there in case you're interested. The thing about the share is that it's got both contract and property connotations. So the idea of a share transaction is both a creature in contract, but it's also a proprietary interest. And that has created a little bit of tension in the way that the law interprets it and what it means. It expresses itself in the occasional lawsuit. We had some interesting ones emerging out of the financial crisis. For instance, Hank Greenberg. Hank was the boss of AIG, the insurance company. It spectacularly collapsed during the crisis in 2008. Right? It was one of the big financial collapses, at the time after Lehman Brothers, that, financial institutions were dropping like flies. One of them that kind of went kaput was AIG, which had tremendous connotations because it was a very big financial institution in the US. It got bailed out by the government, but it got bailed out in takeover by the government. And then Hank, who is shameless, went and sued them, saying that the valuation of the shares, the amount of money that the government purchased those shares in order to save the company, right, to take it over, it was incorrect. So he was arguing that they got expropriated, which is really rich considering that the institution had collapsed, so they shouldn't be having any value at all. So instead of saying thank you for the government buying their shares at any price, he was complaining about the valuation. But this is one of these ways in which about the nature of shares and the understanding of shares from a legal point of view are emerging, and it's not just at the beginning of that process like 100 years ago. You've also got ongoing cases that bring these issues forward. Right, but let's think a little bit about the markets themselves. Why do you need a market? You can always transact on a bilateral basis. In fact, many of the transactions in the markets are on a bilateral basis. So why does it need to happen in a market? The important thing about a market is that it makes things easier. So themselves could be done on a bilateral basis outside an exchange of some description. The problem is, if transactions are taking place outside a market, they're not very transparent. So you don't know about the volume of trading, and you don't know about any stresses that are developing in the system. This has been demonstrated during the crisis. Again, things that were going through exchanges and markets, they were monitored. Things that were not, like over-the-counter derivatives, for instance, nobody knew about them. And when the system started experiencing stress, people could tell on the traded products where the problem was and how the prices were changing, but people could not anticipate how the derivative products that were not going to the exchange were going to be saved. And it was the derivative product that blew up and caused massive liabilities that then the banks found themselves in trouble. one of the key issues of a marketplace is transparency of the transactions and security, but very crucial is the meeting place for the sellers and buyers. You do your shopping by going to individual providers, right? You could ride up to the farm and get some fruit, and you could ride up to the other guy and get some meat, and then you can rise up to somebody else and get some But if all of them come on a Saturday morning in the city square and they're all there, it makes your shopping a lot easier. Because what is important is that you've got multiple providers that then we can compare prices to the multiple providers. There's not only ease of access by having a variety of products and a variety of options from a variety of providers at the same place, the same systems, but also you've got a lot of people selling the same stuff, so then it helps with price competition. So we're all worried about the market is that it makes it easier to transact, it makes it easier to discover prices, and it's easier for the buyer. So that you add the security elements, that if everything is more transparent, then it's more obvious when the risk is developing in the system in case something goes wrong. And in some exchanges, guarantee the transaction. So they guarantee the passing of the money for one person to the other. So they ensure that there's enough liquidity in the market in order to be able to meet the trade. So this doesn't necessarily always happen, but certain natural markets also offer this capacity. But if you're thinking about forex markets, currency exchanges, or you're thinking about stock markets, think this very obvious out. Right? You've got a centralized system that will handle the transaction. So the money passes from you to the exchange, then from the buyer to the exchange, then to the seller. The product, and then makes it way across. So you unless the risk of sending the money over and not getting the product at the end, or not, but everything will to pay you with the cube systems. So all that makes life simple. So there are significant advantages into having markets where all these things can happen. We can talk a little bit more about banks and what the banks are supposed to be doing. Now, we've got different types of banks. What is the main function of a bank? The main function of a bank is taking deposits, and then making loans, right? Could we manage without banks? No, we cannot manage without banks. I mean, a modern economy cannot manage without banks. And not only that, it's an issue of credit availability and liquidity. And the crucial function of a bank is the fact that it creates money. The bank is not a simple depositor of money. It's not like a vault. This is the idea behind fractional reserve bank. If you've got 10,000 in your pocket and you go deposit them in the bank, the bank loans, but the bank doesn't make loans just on the 10 pound. It can make more. But what happens is that the bank has to navigate money and fund. So the bank has to make these projections. It's taking money in, it's giving money out, but it's not happening simultaneously. It took the money from you now, so it's quarter. It is giving the money to somebody else, but it's also receiving money from other people who make some back payments. So it's a dynamic system that's very complex. So what has happened very early on in the history of banking is that the banks started giving out more than they actually had. And this is perfectly normal. And this increases the money supply. But of course, this needs to be controlled because after a point of time, they say there are mechanisms that tell the banks how much money you need to keep us immediately accessible, right? In case somebody comes back and asks for money. How much money do you need to have in general in a variety of investments? And then out of that money, how much can you make out as well? And it's not a one-on-one, so like you have £1 there in the vault to make £1 as well. It is multiple. And If you allow more of it, so if they can make 10,000 in loans for 80,000 that they put in default, then it increases the availability of money. Because it could be that in UK, they only give them £10. And 10 of us have gone there and they got the loan with £10 every day. So the money created in the system, starting from your £10, then create £100. That's how they see it. And that is real money, right? Now, this is an essential component of credit availability and liquidity in the economy. It is essential in allowing the business we described previously to have access to that money so they can expand their business. This could not happen without the banks. There's a lot of discussion about these things, and we don't understand them. And to be fair, there's a lot needed to understand. It's not like you gotta wake up one morning and you read a paragraph about how the banking system operates and you get it. I mean, I've been working on that as well. But it takes a while because the functions of a private banking system are very different from what the central bank can do. Yes, the central bank can create liquidity, but the fact that, I mean, they can print money, but there is a limitation to that because after the point it causes inflation. So there are ways in which you can create that the central banks, the state mechanism, can create money and expand the money supply, but there are natural limitations. So the two systems work together. So on the one hand, you've got the central bank controlling their way to liquidity in the market, and then you've got the private banking system, but also the private banking system that also generates liquidity and credit. So the different types of banks, you've got a part of the banking system that is focused on the consumer deal with this, the loans and the deposits, right? The places where you go, you got your current account, you have perhaps a savings account, and then you get a loan, buy a car, to buy a house, and all the rest of it. This is again bread and butter of banking. Commercial banking is this on a larger scale. This is where the companies get the money so they can finance directly. So it's a sort of situation that you go with your business plan and your projections, and you ask the bank for a loan, and then they help you proceed with working this. Now, another side of this is the investment part. So on the one hand, you've got your consumer and commercial banking, which are the people who deal with the real stuff. So it's like the real economy, things that are actually happening out there that are for the protected elements of them on a productive purpose. However, all of the one aspect of the economic landscape, the money and the management of the money itself. So this is not product, not necessarily product, right? So quite a lot of effort and quite a lot of the banking system is devoted to churning the money and making sure that the money is invested in a variety of ways, but this will not always have a productive. So some of it is in the kind of virtual money if you want, but it's not something that you get to see invest in protect. Even they exist for the bankers and buy government bonds. And they're really making a good living out of this or they buy government bonds or they buy corporate bonds. This activity finances an economy further down the line, but the actual activity doesn't really do anything very well. But all of those are essential components of the economy. In the city, a good proportion of work, the city, a bigger part of work, city is make the money. It's also massive commercial banking aspect that they were a center of global finance, and it's most of that. A place where people get together to manage. Now, investment banks, what the investment banks do, they advise other actors in the financial markets as to how to do this. So they've got the know-how and they've got the experience and they've got the technology to understand how these things work, so they sell people with effect. So you want to rate your company in the stock market because you would like to raise money from the public. How are you going to do? So there's a lot of paperwork, a lot of bureaucracy that you need to go through, and crucially, there's a lot of financial information materials. All in order to do this properly, then you need to hire an investment bank to help you through the process. How much are you going to sell in shares? You have to think very carefully about the company you are, what people are willing to pay, how well you proceed, how much money you take to raise, for which purpose you raise it, and all that. So this is something that you can do on your own. If we're talking about a significant company with a significant valuation, they need close on an investment bank to help you do it. So this is what,
all these really rich guys in very expensive suits and really big buildings and nice car pictures for them. It looks that it's not particularly socially useful. However, what happens in there at the higher digital finance is what makes the money go around and finances the rest of the economy. Now, the argument is that these people are getting paid too much. It depends what how a society values it. So each society thinks that the teacher of the school who takes care of the kids all day is worth 10,000. The guy who sits and looks at the streets of the principal is worth 20 million. Yeah, this is social decision. So we can argue about this if you want. We can talk about whether the compensation that is this fees and the cost of these services are actually socially useful or relevant, or maybe they should be structured in different ways. We can talk about that. But I think to take the satisfaction about that and come to a conclusion that we don't need them, or that they're useless, or that they're dangerous and we should get rid of them, I think this is the wrong conclusion. So we can talk about costs and the compensation that comes in financial senses, but we still need it. I mean, our equality in modern economy cannot operate without. We can pay, or you should take that other people that paid under the adequacy in the relation to these guys to make so much when you can pay the other people more.
Have you had enough already? It's time to take a short break. Pause the recording, take a few minutes, and then come back and continue for the rest of the lecture. So we talked about the role of the investment banks, and this is called underwriting. Okay, so the process of helping somebody bring their either enter a bond market or enter a stock market. This is described as underwriting. The problem with all of that is that all of this is a little dangerous, because there's so much money involved in such big proportions that when something goes wrong, it can have real negative consequences on the world around it. And there's a difference between valuations that could be fictional money and the actual problems that come when somebody goes bust. You know, Tesla, right? Who thinks that Tesla is overvalued? Everybody. Share price goes down $100. So they say $6 billion has been wiped off the value of Tesla. And tomorrow Musk announces that he's shooting his bolt up in space and everybody's very impressed. So the shares go $100 again, everybody goes, $10 billion added to the price of the company. People read that stuff. What is the conclusion? It means that. How is it possible that a company that was worth X today is worth Y tomorrow and is worth Z the next day? Nothing has actually really happened. They didn't discover anything. They didn't do anything. They are continuing business as usual. It's just perception, right? The Trump says, I'm having a bad day. I'm going to put tariffs on somebody. Everybody panics and, the stock market's fall. The excellent opinions whacked off about it. What is that? This doesn't mean anything. Right? So these valuations in the stock market are, so long as they're not transacted on, they are perception of value. They're not the real value. The real value means when you actually sell the shares and the money reaches your bank account, then is the real one. Okay? So the fact that the price, it could actually thrive on a small number of transactions. Yeah. So think the shares don't change hands, so the money is not exchanged. So nothing really happens. Nobody becomes rich or poor. If a bank goes bust, and you go to the ATM and nothing comes out, these are real consequences. But one can insect the efficacy, because when people panicked in 2008, and all the grandpas were chewing up rows and rods because the bank shut, that was a problem, okay? When they imposed capital control, story broke in the morning, everybody was chewing at the ATM to get out as much cash as they could. This is not good.
this can create a real life issue. So if the people had their money in Icelandic savings accounts when the banks collapsed and they took them years to get it back, and they were lucky because they could have lost it all, that's real consequence. It's your life savings, the same fine. I mean, we look at it from a distance because we assume that our money is safe. If they told you that your money isn't safe and you buy like shut tomorrow and you put, instead of lifetime, letting it sell away, poof, it's gone. That's not funny. You wouldn't go out and try and smash something. The state has an obligation to create some barriers. So these processes that are so essential to the economy are actually maintained and they're safe. Because we want the banking system and the financial system to be there to support the economy, but we don't want it to come off the rails issue. And how do we know that the whole thing can go? That's how we know, because it's what happened in the 30s. This wasn't good at all. So in 29, they had the stock market crash. After that, they had a banking crisis. After that, everything just collapsed. And one of the arguments there is that the consequence of the financial collapse, what led to the war afterwards. So that the disrupted and by the collapse of the financial system at the end of the 1920s, they created a dynamic that fueled this aggression and dissatisfaction that led aggressive regimes to take power and then implement aggressive agendas like the fascists. That's what happens. Things go seriously bad. People are seriously dislocated. They're seriously frustrated. In Europe, there was also the legacy of the First World War and others unresolved problems from there, and you end up in this situation. So the obvious conclusion to draw from this is that the state has an obligation to ensure that big-time financial collapses do not happen on a regular basis because institutions not even themselves. So again, the politicians and the bankers and the financiers always tries to come out of the boat, but it's disruptive for the finance. One of the things identified at the time was the danger from what's a problem on one part of the system traveling and infecting other aspects of the system. So you've got your more dynamic financial markets on the investment banking side, and then you've got your kind of more normal consumer commercial policy. The concern is that people in the investment side, if they do things that are too risky, they shouldn't actually infect the other bits that are supposed to be stated. So there's one issue, making wrong investment decisions in stock markets, in bonds and stuff like that, and gonna the fund manager who sits there playing on the spreadsheets, loses some money and gets fired. There's a difference between this and actually losing all the money that people have put down as savings and all the money that's supposed to be the working capital for everyday business. That is bad. And one of the things that happened in the 20s and the 30s is that there was not this same barrier between investment side, the more risky bits of finance, and the everyday run-of-the-mill high-state bank. So one of the solutions that was envisaged at the time was the creation of the separation between investment banking and commercial banking, which was expressed in the Glass-Steagall Act in 1950. But of course, this is not... Glass-Steagall is famous. However, it was only one component in a large array of measures that attempted to make banking finance more secure for the moment. So what happened is that you had this distinction between different parts of the banking system, not to allow speculation to lose the money that was needed for everyday activity, and generally to reduce the size of the financial industry, reduce the dynamism of the financial industry in order to make it safer and less prone to fraud. So this this was implemented in the 30s. This worked in stabilizing the situation for a very long time. I'm not talking about the economy in general and growth, but specifically about finance, because what they stabilized with the economy was the war. Because then, there was an emphasis on productive activity, not to respond to the needs of the war. But after that, from the 1960s onwards, banking was relatively controlled. There were a few occasional collapses and crises and so, but nothing of a systemic nature though. Now, after a few decades pass, people started to view all these regulations and restrictions as artificial impediments making a profit. And because there have been so much time since the crisis, people lost memory of the crisis. And the people engaged in the industry, they were looking all the time thinking, why do we now all these rules just prevent us from making money? Which happened through books, perhaps sooner than others. Because these guys were already rich and quite powerful and quite effective in lobbying. They lobbied at the governments. The governments like to take money from people so then they can spend it elected. So there was a gradual process of kind of lifting all those restrictions that had been placed. So the 1980s onwards, you begin taking out those restrictions. And this accelerated from the 90s, the whole idea to try and kind of liberalize the market in a variety of fields, including in financial services. So this kept going on and on and on. Until you had the abolition of all of that stuff. And then you started having some ties. You've had significant instances of collapses in the stock markets of the end of the 90s, and 99, the dot-com bubble that all that. You've had significant imbalances in financial markets. This was not necessarily taken care of. Because the regulatory efforts that led all these stresses developed in the system, they were not adequately addressed, even though they had enough warning signs. But because so many people were making so much money, it was all so cool, and things were progressing well for so long, people didn't see the need of kind of putting the brakes. Let's still the whole the stresses in the system build up and the whole damn thing collapsed.
Now, what happened after that? People rediscovered the need for some regulation and some breaks and so on in the financial markets. Again, aim is not to shut them down. The aim is to make some of the riskier aspects of the market more controllable so they don't cause crises that kind of cross from one part to the other. A good component of all this is the role of the central banks. The central banks attained a much more significant regulatory role over financial markets and financial stability. And what has happened since the crisis in 2008 is that now we've got mechanisms that are focused on systemic stability. Before we had compartmentalized regulators over different fields that were focused on their particular area of activity, but nobody really was looking at stresses developing across the system and how the different parts of the economy and different parts of finance were infecting each other, causing the capacity for some big land collapse. So now we've got this. Primarily, the regulatory effort is on the central banks to keep an eye on systemic risks, and the economy ministers of various countries. They work together. Plus, you've got a lot more thorough regulation and things, some of which are here. MiFID, the regulations on financial instruments and so on. The directives are significant components at EU level of achieving uniform regulation of the financial system in order to dispel those risks to the extent possible. Now, people in the industry hate all that stuff. Because it is bureaucracy, they say, because it doesn't really change anything. I mean, I've heard this argument a number of times that with paperwork and others involved in everything and all the licenses and all things, they're actually looking at the wrong stuff and they're not going to make anything fine. But, we saw what happened when you didn't have any of those. So, let's try something out. They primarily don't like it because they increase. Because before, when you were issuing financial products, there was this tick, like in the prospectus. Then this tick means that you need to employ an army of lawyers with very low fund, and this costs a lot of money. That's why you see so many copying finance lawyers working it out, yeah? Because COVID, with the regulatory requirement now, is a very significant time-consuming, very expensive process. But the whole base is that this makes things more secure overall.
Now, our friends here in London, those who are not on the consumer side, those who are ones in the money markets and all that stuff, because they think that all this is a waste of time, they see a great opportunity in Brexit in allowing Britain to deregulate. The thing is that if they're not covered by the European rules anymore, they can do away with all this bureaucracy and they can become a global center that is more lax, like they used to be, but the money can pass with here and they can do nice deals and stuff like that with much significantly cheaper in comparison to the European counterparts that still have to deal with this. It's fine, okay, that I understand. If you're a ship funder, there are advantages in do this, and you could go with the government in that direction. So you can build the competitive edge by having lower regulatory burdens and having lower taxes. It's fine, okay. But of course, there aren't that many of those guys, and those guys are already rich. So the question for the government is, why did the government prioritize a very small, the interest of a very small number of people on a section of the industry, not even the entire industry? Why go for that as opposed to the interests of the rest of the nation who are completely unfit always? Because the consequence of doing this, deregulation and lower taxation, is with you on a number of other fields, which has got is going to have catastrophic consequences on a range of other factors in the economy, including a good section of the banking industry itself. But I'm not talking about why people vote for Brexit. I mean, that's something else. I'm talking about why do the sort of industry leaders and the people with the money and the people with the access to the government, why are they not more against it?
From the point of view of your studies, what is relevant for you is the EU regulatory framework, either because you're from there or because there's going to be some transition, so this is going to stay till after you've graduated, or simply because from wherever you are in the developing world, you have to do business with Europe, and Europe has to do business on those terms. So this is not going away. If anything, this is going to get tougher. And actually, I'm not a believer that they're going to be able to deregulate here. Reducing the regulatory burden is one thing, but then it means you won't be able to do business with most of the other jurisdictions that actually have higher requirements. So you're going to need to, you just simply won't be allowed. It's going to create barriers in the flow of the money, so it's going to be detrimental here. I mean, you cannot, the Cayman Islands is like 5 people in there, okay? You cannot do this. A big economy cannot be supported just on the activity generated through these types of funds. Everybody who needs to do business with the Americans or the Europeans is still going to have to apply higher standards. So that in itself is not as sufficient. The volume is not sufficient. Dropping taxes is just not possible because the financial industry here in the City of London is the key contributor to the budget. If they drop taxes significantly, they're going to run out of money at a time that it's going to be more expensive for them to borrow. So it's just the finances don't work for the state for them to deregulate and drop taxation very sharply. Supposedly people here are unhappy with austerity. Wait to see what happens if they lose money from the taxation from the city. We talk a little bit about banks, specifically because we were talking about kind of financial institutions more generally last week, but I want to have some more specific information about banks. There was always a demand for somebody to hold on to your money for obvious reasons, that after a point, it becomes unsafe to hold about your person large amounts of wealth. And before, in the Middle Ages, for instance, before the times of centralized, secure institutions and governments and states, wealthy people used to hide wealth inside castles with kind of moats and alligators around. But if you were a merchant, so the higher end of the Middle Ages, where the merchant class began to emerge, that they began to accumulate money, then, having a way to deal with this accumulation was becoming an issue. And also, money sitting around buried in the garden doesn't really do anything. It runs the risk of getting stolen, but it does not really produce anything. So there's an obvious demand for somebody to take care of your money, not only in terms of providing some security for the actual asset, but also providing you some return with that money, do something with it. You've got systems around money and exchange of valuable things for other valuable things. The money changes that Jesus threw out of the temple, right? This is evidence of institutional inefficiency because they had too many different types of currency circulating at the same time. So you needed the money changes to help you facilitate those transactions close to a marketplace. Pissed off a lot of people, Jesus included. But there was this demand for some sort of banking service, and you have the beginning of evolution, rather, of the money changers into deposit takers about 1300 in Venice, of all places. Why Venice? Because Venice was a commercial center at the crossroads between East and West at the time. So you begin to have the idea of businesses that specialize in taking money from one person, then making it available to other people to engage in productive activity, and then returning that money to the depositor with interest. And why do they engage in this business? Because they obviously take a cut. So the rate that, you give the money out, you obviously, what you earn, you pass a proportion of that as interest back to the depositor. You don't give them the whole thing. So that's another spread, if you want, the difference between the rate of interest that you're giving to your depositors and what you're earning from the people that you make the loan to. So the two different rates of interest, the spread between them is the profit of the bank. Now, this exists everywhere. You can call it whatever you want. In Islamic jurisdictions, you're not allowed to charge interest. It is not called that, but the effect is the same. So this whole debate about the whole function of Islamic banking is a different way to achieve the same outcome. It's just that rather than calling it interest on deposit, you're calling it profit earned on contracts. Basically, the prohibition in Islam is that you cannot make money out of money without doing anything. So the money is not supposed to kind of self-replicate. This is not allowed. But the contractual transaction is structured as the product of the result of a productive engagement, and then it's fine. So basically, you can run around loops to create the same effect. But there's somebody who has a look at it that you've done it properly. So if you're thinking in terms of Islamic finance, there's a layer of regulation on this that comes from it being Sharia compliant, that would be on top of traditional banking regulation in the Western context, right? And it has, if you're in an Islamic country, the two are the same, but if you're in a non-Islamic state, but you're selling Islamic financial products, then you need to have this over-the-top compliance, which again doesn't bother me at all, because it looks like you would comply to rules of an institution. Like you list in the stock market, you need to comply with the rules of the stock market, whichever stock market you're in. The rules of the stock market are not the same as government regulation. However, they are a regulatory barrier that you need to overcome and not be listed. So same stuff with Sharia compliant investments. How much can you give out on the basis of what you're taking in is super controlled by stuff like this. So we're having the Capital Requirements Directive, which at EU level controls the issues of authorization of credit institutions. Anybody who takes deposits is very carefully controlled. You remember the barriers to entry we were talking about? This is crucial, because you cannot allow people to take money and then run off with it and you don't know what happens. So there's a lot of regulation as to who can engage in deposit-taking activity, and there's also great regulation of what they can do, right? We control who gets in, we control what products they offer, we control how much they can loan out in relation to what they're taking in, and all these are security buffers built in the system. The rules that we're looking at are these. So we're looking at the Capital Requirements Directive that is applicable across the Union, including the UK, and will remain so for the foreseeable future. And it is internationally compliant or consistent, because how much money you need to keep aside before you start lending is also controlled by the Basel rules, right? Because there's this wonderful, the Bank of International Settlements in Basel, that a lot of people sit there and think about what is safe, how much money do the banks need to keep aside, what is the ratio between loans that they're making out, and how could you adjust this, what is the best balance between freedom and regulation, and the money that they keep aside as safe, what should it be in, and how is that considered safe, and you got the various tiers that you need to have various investments in various types of funds with different risk ratings, that defines what is safe. Crucial definition is that if we are obsessing about deposit-taking institutions and we control them so carefully because we think that they're so significant, they're the cornerstone of modern finance, we should have a secure understanding of what is a bank. That can be a problem here. If you don't, a bank is crucially a deposit-taking institution. So there are a lot of creatures in this jungle that is financial markets, but the primary animal in there is the bank. However, defining what is a bank is not as easy as you would think. So it has come to the courts. Why would it come to the courts? Because people obviously do not want to be classed as one thing or another, depending on what are the regulatory barriers, right? So if something is super closely controlled, for instance, you have the designation of the bank and you're very closely controlled. If you're not really a consumer retail banking facing institution, maybe you don't want to be called the bank. Maybe you don't want to be called the bank. So then you would be subject to another set of regulations that are less harsh. So banks have got these very strict capital adequacy requirements and all of these things. So you need to keep a lot of money aside. If you're keeping a lot of money aside or you have them parked in investments that are low risk, they pay less interest, you make less money. If you were a different type of financial institution regulated differently, you could invest more of that money in riskier things that pay more interest, you would make more money, right? So nobody wants to be on a more heavily regulated structure. All this debate that we were having about policy, this is looking from the outside in. If you are the financial institution, you don't want to be subject to a more severe regulatory regime. Nobody wants that. The debate of what is a bank is present in jurisprudence in all jurisdictions. We take our examples here from the British courts, England. The best reference to have about what is a bank is the United Dominions Trust case, cited by Lord Denning. Have you guys heard about Lord Denning? He's a super famous judge, primarily famous for having lived for so long. We were talking about him when I was a student. We thought he was dead already. He lived another 20 years after that. He died at 101 or something. So Lord Denning emphasized the deposit-taking function as the core characteristic of a bank. And this designation is not subject to the bank self-defining. So the regulator will decide whether what you're doing makes you a bank or another type of financial institution, and will attach the relevant regulatory requirements to you. So you cannot pretend that you're not. Actually, you know what? I mentioned before, the market providers themselves would not want to be subject to a more severe regulatory structure. It depends if there are any benefits. If there are no benefits, if your designation of a bank allows you to do retail banking, like open a branch on the high street, but you're not, if there's any point in doing that, then why would you go for it? But there are some other things. The big investment banks, they re-registered as traditional banks during the crisis in the States. Goldman Sachs, Morgan Stanley, Bank of America, all that stuff, right? The ones who were not regulated as deposit-taking institutions. They chose to re-register as deposit-taking institutions. Any idea why? TARP, that was the bailout program for the banks in the States, was only applicable to banks. So it wasn't everybody who walked around the financial services jungle That's why they let Lehman Brothers go under, right? So the others, when they realized that they're in danger of actually going under and they wanted to get the funding to secure themselves, they needed to re-register those banks to come under the regulatory umbrella, yes, but also under the protection. So there might be good reasons why a financial institution will choose to accept more severe regulatory requirements. Okay, so the essential characteristics of the business of banking are the collection of money by receiving deposits and the utilization of that money in lending it out. So exactly the stuff that you would expect, and this is what you see if you read cases like this one. We touched upon the idea of there being different types of banks, so we've already made a distinction between commercial and investment banking. So I'm just going to briefly present a few other distinctions here. Now, commercial banking could also be different things. It can be the retail-focused one that is dealing with private personal clients, that high street banks all over the place that you go and you open a current account, a savings account, you get your debit card, credit card and all. You get your debit card, credit card and all the rest. Also have commercial banks that are more specialized in business-to-business banking. Most of the high street banks will do both the customer-facing stuff and the business-to-business stuff and business lending. The investment banks will not do that. The investment banks, most of the time, okay, they deal with the money generated out of this activity. So the investment banks will deal with the financial markets in trading financial products that are generated by the retail and the commercial banks, and they're helping them join stock markets and these things. So the investment banks are the conduit for participation in markets, be they capital markets or bond markets, debt markets, stock markets, all of these things. That's what these guys do. So they're helping their clients in structuring the products, pricing the products, launching them on the market, meeting all the regulatory requirements and all of that stuff. However, they do also have they might have traditional commercial activity as well. They do private banking for high net worth individuals. So all my banker friends that have got like millions and millions sitting around the bank accounts, then they have specialist services provided by those banks. Also, some of them also will do retail. For instance, Goldman Sachs just launched a savings account in the UK. Some other distinctions in banks. You will find in the literature discussion banking groups and universal banks as well. This is a bit of a dodgy concept because banks need to be regulated at national level. So there isn't really such a thing as a universal bank. There is a bank that's got a presence in a number of countries, okay? But depending on the regulatory requirements, you might need a separate registration in each country. So you can have a banking group. You can have a banking group that's got different financial institutions within the same country. I mean, you can have a bank that also has a retail bit, that has got an investment bit, that's got a property investing bit, that's got a private banking bit, all that. HSBC is a good example of this kind of group structures that they do a lot of different things at the same time within the same country and without. But to talk about universal banks, it could mean two things. Universal in the sense that it offers all types of services across all these domains, but also it could be that it's spread across borders. So you also have this division between domestic and international. Just keep in mind that if you're operating internationally, you need separate banking authorization in each jurisdiction business apart from the EU, because if you're placed in one area in the EU with the financial fast food, as we explained, you can do business everywhere else. So you can open a branch everywhere else. If you open a subsidiary, which is a fully fledged bank, then you will need to get separate authorization from the local regulator, even if you remain within the EU. So this is the difference between a branch and a... What about the idea of the relationships between banks and the industry? Could a bank or rather, could an industry create its own bank to lend to it? Manufacturers set up their own bank in order to fund auto manufacturing. The extent to which this thing can be done will depend on the regulatory requirements in its given state, but the link between bank and industry is not there. The reason is that if you have too close related between the people who give the money and the people who receive the money, and they're looking the relationship together, then the incentives for them, they are diffused. So if we might invent in dangerous ways to businesses that don't preserve the law, just because you're in this still be open in the nation. So perhaps an entire industry like, auto manufacturers or petrol companies or something could have closer relations, particular relations, but people are buying to an institution that specializes in that domain. That's fine. But the other way around, a bank that owns an industry is very broken up. Because if you bought in a bank that owns a petrol and its main activity is lending to that petrol company, what are the checks and balances that this lending is actually protecting and is done on good terms? It is actually going to return invest. Because then if the bank and the industry are so closely based together, the bank is just a vehicle for funding the industry or funding the particular business. If they're all owned by the same people, there's this concern. Where does the money come from, right? So if you have a state-owned, fully state-owned bank that is there to channel financing doesn't enterprise, but in the state bank or company or whatever, then it's less danger of losing everybody else's money. But if you have a private bank, linked to a unique industry and send off all the rating with that, then there's a great risk that it's not done with market incentives in mind, and when the industry goes kaput, it's going to take with it the bank. And we've had this problem in countries where banking was more heavily regulated and more controlled by the state, and the states created banks to finance particular industries. And those of you from Europe will recognize this. You have the agricultural bank that was meant to fund agricultural business. You got the commercial bank that was funding commercial. You had the Navy bank that was funding shipping business, right? So all of that is highly problematic because in Greece, for instance, there's been great scandals about this. The agricultural bank was getting money from depositors. Not only that, by law, the pension fund for agricultural workers was obligated to deposit its money in the agricultural bank. So you see how things are linking together. So agricultural workers are obligated to make contributions to this pension fund. It's state-owned. The pension fund is obligated to place the money into this bank. They're obligated to make loans to state-owned enterprises in agriculture. Of course, the whole thing is a scam. Because nobody was thinking about, is this loan an appropriate way to invest the money for our clients? And then the bank was giving it to the enterprises. There was a constant stream of money to the enterprises. Nobody cared about running a productive business that makes any money. So then, the agricultural businesses went bankrupt, the bank went bankrupt, the pension fund went bankrupt, the country went, and then the linkage between industry and bank sounds lovely, but in practice creates a lot of perversion that is at least 100 amounts of doubt. Because if you're listing the treasury's money, that's one thing. But if you have a bank that they even deposit those money that got nothing to do with it, and then it's lending for non-market objectives to some sort of kind of dodgy state-run industry, they'll have a serious problem. Because when it goes bust, is the state going to compensate the people that lose out? If it does, okay. But if it doesn't, then, the retail customers are left holding the bag for an arrangement that they didn't even know about. This brings us back to the discussion about the link between banks and industry. This is a thought you want, so you need to be careful. A bank fully owning an industry, bad idea. Industry creating a bank, dodgy idea, but there are possibly a little bit more. All of this is very carefully controlled. Now, EU, the main instrument is the Capital Requirements Directive. And this is done across a union level, which allows then the banks to offer cross-border services and for regimes of regulation to be mutually accepted at face value without needing to recheck people's national authorization. So what will the finance solicitor do? Well, you need somebody who can do a deal to arrange the financing. This is for young companies or new deals that are taking place for new things that are created. So a finance solicitor, a friend of mine is a finance solicitor. That's what he does. He gets the people with the money, with the people with the idea. First of all, gets them to meet together, because they don't necessarily know how to find each other. So specialized law firms, they've got the connections and they can identify links so they can do this networking. The money get together with the people with the idea and they want to invest in something. He helps them around with the paperwork, which has two forms. One is the contractual deal. What is the deal with each other? What are they actually trying to do? How are they channeling the money from one to the other? What do they expect to get? The contract drafting function of this is very significant, right? And takes a long time and a lot of negotiation, but also, because this is about money, is doing the compliance work that has to do with producing legal language that is compliant with all the regulatory frameworks. So the finance solicitor is the person that will do this. And this ranges from the general banking to capital markets to project finance and complex financial products. Think about, how do they fund Crossrail, for instance? Crossrail is a big project that is going to build a new rail line from east to west London. That, it's a big piece of infrastructure that's going to be useful for London. And they were funding this by issuing bonds. So you issue bonds on the thing, people buy them, then it repays back these bonds with interest, assuming out of the profitability of the whole business after it starts. Yeah. But of course, you need somebody who can do this for you, both to structure the deal, that the money can go through properly, but also to price it appropriately and then launch it on the appropriate markets and get it done. So being a finance solicitor is... It takes the regulation works that you get it from deep to understand the taking out legal, to the regulatory frameworks, they well, date, and also it requires a person who is good at negotiating with people. We follow on from what we've been debating about creating a common space, if you want, in Europe, at least in terms of banking and finance, and an attempt to deal with the issue of inconsistencies in cross-border profession. So our starting point is that everybody agreed that an integrated system for financial services is a good thing. But there's no debate that everybody thought that this is a good idea. Hence, what you have, the creation of the single market and the idea that the single market contains capital movements. And within that is the idea contains services and capital. And the two together give you financial services. So the ability to move money around and to offer services across borders, including in banking services. So this is a fundamental component of the single market in the way that it's been conceptualized, and it is what everybody has been trying to do ever since. The difficulty is that if you're dealing with a set of inconsistent requirements, or if you're a system where you got a multitude of providers, there are many countries in the EU, right? And it's gotten worse rather than getting better. So there are way more now than there used to be. And every time that you expand the circle of member states, you have to deal with more inconsistencies and perhaps more severe inconsistencies. Because at the beginning, you had the Union of 12, that they were not necessarily very coordinated because there was a great difference in the way that they were doing business between the north and the south of Europe. But once you entered into these Eastern European countries that came from a non-capitalist background, that everything was new in terms of laws and institutions and so on, and these new laws and institutions were created in order to be able to coordinate with the rest of the EU, then you created more challenges. Yet you now have a system that is supposed to be a common market in capital and services and all of these things and to operate, but it doesn't, right? And you cannot do everything in one go. Think about the idea of supervision. We have seen in the last couple of weeks that banks and financial services providers need it. Why do they need to be regulated? Because they take people's money, and the disruption that will ensue if they lose people's money is going to be very severe. So the fundamental basis of an economic system is the security of the assets is one thing, but more crucially is the security of the money itself, and that the state is there through the central bank most of the time, is there to guarantee the value of money itself. Systemic banking crisis that call the very existence of money and the value of that money into question. How do you deal with issues of things going wrong or dodgy providers entering the market? So you got a variety of checks in as entry criteria that you do not allow anybody to enter into the provision of these types of services because they're considered so important and so fundamental. Now that bit was perhaps easier to harmonize, and the means to harmonize it were the European passport, as we've seen. So you intergovernmental coordination in the regulatory frameworks and in the checks and balances that you've got in place before you allow providers to come into place. You got some European rules that are supposed to be equally applicable for everybody. And crucially, you've got the level of coordination that gives you the confidence that somebody authorized from the French authorities has gone through the same vetting process as somebody authorized through the British authorities. Therefore, you can let somebody authorized through them to operate here, and you don't need to put them through the process of reauthorization. This is not based on trust. This is based on check, which is another debate that has come around now in the context of Brexit. People are saying, well, why is this so difficult? I mean, surely we've been doing business for decades. But what's the problem gonna be? So why can you suddenly, if there is more particular agreement, why would you suddenly not recognize that providers in financial services authorized by the UK are good like they were a week ago? So what's gonna change between, like a week before Brexit and a week after Brexit? Is the same people, you've been doing business with them, the standards. But you cannot trust the standards to remain the same. That's precisely the problem. That now everybody is bound by the same set of rules. There are institutional means of communication between the various regulators. So there are central structures, and there are also communications both with the central structures and across the system. So everybody makes sure that they play with the same rules, they apply the same rules in the same way. This is not simply trusting the other person to do their jobs properly. Why do we have X for imported goods that are coming from the outside? Because we don't trust the Chinese to produce things accordingly unless we check the standards before we allow things to be sold in the market. And these are not things that
because they're dangerous. You cannot control them if something goes wrong. So you cannot say, well, assume it's okay till, kind of phone blows up and kills somebody. We want to make sure that the phones and the electricals and all of these things are not going to kill somebody. Because we perceive this to be in the public interest. So the problem with Brexit is, it's not like suddenly they're going to go rogue or do something weird. They're probably going to continue to do exactly the same things they were doing, and they're going to be fully compliant. But because you lose the institutional overseer and you lose the line of communication between the regulators, you lose sight of how things are changed. And because you lose sight of how things are changing, it cannot simply be based on trust, that you trust them to do the right thing. You need the institutional controls and the oversight of the courts and the regulators on a cross-European level to allow these things to operate. This is precisely the problem. So it's not nobody's implying like some evil intent. It's a concern about having the institutional checks and balances that things remain the same. And also there is a concern in Europe that they might lose in the competitive sense, that if here they start to relax the standards for certain things, or if they start to reduce the taxes, but that there might be competitive pressures over there. So Europe does not want to take the risk of being penalized for having higher regulatory standards as against the UK once the UK makes, which is also normal. Okay, I mean, they will do exactly the same. People were banging on about Ireland's corporate tax rate for years, right? So everybody had a problem with Ireland, but now everybody's going to be happy that Theresa to put the cheapest corporate tax rate in the G20. But the creation of the system of checks and balances, the central regulators and the communication channels between everybody else in the member states is not easy. And every time that there's a problem or some crisis, you realize that there's more stuff to be done in order to prevent this from happening or to kind of reduce the risks of it happening again. And what we ended up having before the financial crisis is that we had a system of control at entry level, but the system that dealt with the problems once they came up was compartmentalized, and it was based on national law. The weakness with this arrangement is that you have banks that are operating across borders. When they fail, the effects are going to be felt across borders. So their entry into the system is checked, but the failure is not have national regulators dealing with the failure of financial institutions in different ways in what is supposed to be a common market. Because then you've got differing outcomes. You could be sat here and you could be an investor in the French bank and the German bank and the Greek bank. And the Greek bank fails and the French bank fails, you would expect consistent treatment. You would not expect varied outcomes in a common system just on who's doing the resolution of the failed bank. So you have now a development of a lot of things to bring these together, both controlling entry, controlling how they work, and then controlling what happens if they go wrong. So the whole idea is the organization of banking supervision. So how do you check them while they're still alive, right, and what they're doing? And they've done this through what is called the single supervisory mechanism, puts the European Banking Authority in control of the banking system across the whole of the Union. And they have these functions of checking the operations of people. So if banks start to get into trouble, there are mechanisms to intervene, and they're keeping an eye on an EU level, not simply everybody having a look at their own jurisdiction, forgetting about crossover effects in other countries. It could be that the stress in a bank is coming from its investments in another member state. It's not in another member state. It's not necessarily within its own. Now, what is the difference between the European Banking Authority that was in London and is now leaving? What's the difference between the EBA and the ECB? Now, the ECB is the banking regulator for the Eurozone, but the EU is a bigger structure than the Eurozone. So the two work together, and to an extent there is some overlap in the functions, but you could not
consolidate these support and control systems just for the Eurozone and forget all those member states that are not actually in the Eurozone. But that is a bit difficult to handle. So you see some tensions created over there as well. Now, what is the effect of the creation of the EBA and the single supervisor mechanism that it runs? What it is supposed to do? It is checking the things that come under the Capital Requirements Directive, which means how much money do the banks need to keep aside in order to be considered safe. And it also checks that banks have put in place the systems and plans and mechanisms to deal with the possibility of collapse. So the Capital Requirements Directive, we're going to come back to this in a moment, is the thing that says how much money, what sort of things are you allowed to invest in, how much money needs to be immediately available, how much money needs to be available in the medium term, and so on. So if the bank experiences a lack of liquidity, a lot of people come and ask for their money, how do we ensure that the bank has got enough reserves in action to pay out, right? And this is something that's done in a coordinated fashion for everybody. And then we get to the point of what happens if a bank fails. Now, because you've got a single supervisory mechanism across the EU, everybody gets the same treatment. So there's €100,000 guarantee per depositor. So if a bank goes bust, the local central bank will give you back your money up to €100,000. Yeah. If you got more than that, you lose it. It depends how badly the bank has failed and what's left. But then from that point onwards, you count as a creditor of the bank, and you have to see through the insolvency process or the resolution process, right? This was, before the financial crisis, this was dependent purely on the national regulators. Some were guaranteeing more, some were guaranteeing less. Here you've got the Financial Services Compensation Scheme, that is the local body that gives impression to these rules, that will guarantee up to some pounds. If you're a retail customer, so this is like money in bank accounts, right? It's not investment products. Money in bank accounts, they will guarantee up to 100,000. So if you have your money in Northern Rock goes bust, then you cannot get your money out of the bank. Then the government is gonna give it to you through the Financial Services Compensation Scheme, and that's why it is important, as we said in our other class, where do you open your bank account, right? If you open your a savings account at the post office account is operated by the Bank of Ireland. So then you're under the Irish compensation scheme. Not be such a good idea now with Brexit. If you currently have, and if you're running retail banking, your normal accounts are with a branch of a European bank, you will be receiving letters now that tell you how there's going to be changes because your bank is re-registering in a UK subsidiary. All this stuff is not fictional. That's what I'm telling you. People are doing what they need to do now in anticipation of this thing happening in a few months. So Citibank, where I've got my current account, send me this letter to say, you're going to start receiving letters, We're starting a subsidiary in London. Because so far, Citibank was run through a branch. The European bank was headquartered in Ireland. So they were using the financial passport to provide banking services to retail customers in the UK through a branch. But now, because of Brexit, they're set. What happens with the capital requirements regulation? Now, the capital requirements regulation is meant to deal with this thing of what you do if a bank fails. Banks fail all the time. I mean, in living memory, banks have failed. Northern Rock with a bank here, the banks have failed. Northern Rock with a bank here went kaput. The Icelandic, but Lehman Brothers was a retail bank. Yeah. I'm talking about the retail banks, stuff that you actually have your money in. Okay? The Cypriot banks went kaput. So as the Popular Bank of Cyprus, that was all over the big bank and big presence in retail.
Northern Rock, gone. The Icelandic banks, there are a lot of online banking as well, gone. There's a lot of things that have gone. Many.
So how do you deal with banking institutions failing? After banking institutions failing, after the financial crisis, they came up with the directive that has inputs the obligation on each provider to have a three-level plan. So that has to do with preparation, early intervention when things start to go wrong, and provision for resolution. Preparation. So all banks are obligated to come up with a recovery plan. So they need to think about and prepare for situations that lead to financial stress or the failure of the bank. So you need to have your recovery plan, resolution plan, and this needs to be deposited with the regulatory authorities so they know how you intend to deal with things if you run out of money and you cannot meet your obligations. Now, if a firm is facing financial distress or thinks it's about to breach its requirements, right? Its regulatory capital falls below a certain level, for instance. These are known as triggers. So then the authority can intervene, and you already have a course of action here for this early intervention as you're getting into the crisis situation. So the regulator can replace the firm's management. They can require the firm to come up with plans to mitigate the problems. They can start implementing the recovery plan that's been put into place, or they can move the firm into the resolution phase, thinking, okay, you guys are going to fail anyway, we're not going to put you into the process directly. And the last element is that you need to have a resolution plan prepared already and ready to be put into place when necessary. The resolution tools that are available could be to sell or merge the business with somebody else, right? So you need to have some thoughts already as to how this could be achieved. You can have a temporary bridge bank, so you can make these splits between, the bad elements and the survivable elements, so you can begin to create parts of the system, parts sold off to somebody else, so part of it survives. You can also start transferring assets to a different vehicle, so then you can sort of break up the things of the bank that are failing against the bits that are healthy. Or you could begin already to write down and convert liabilities. Now, what does this mean? It means that if you know that you're having trouble, you have lots of non-performing loans. Now, what are non-performing loans? You made a lot of loans to retail customers, they're not paying you back. So you have a lot of credit card debts that you notice that people are not paying back their credit cards. Or you made it back, or you made a lot of auto loans. So you begin to have every bank has got a portion of its portfolio that is actually debt, it's not getting paid back. If you're getting into a crisis situation, your recovery plan should have already based provision for this. To say, okay, we have out of 100% of our loans, 15% of those loans are not getting paid back. Do we hold on to them? Wait for them to default so we get nothing? What are the chances of recovery that we put on those loans? Isn't it better to package them now and sell them to somebody else at a discount, so at least we get some money and we'll settle the total. So these are the sort of things that are going to be put into place when you hit those triggers that you're getting into a stress situation, and you need to improve the capacity of the bank. And the way normally that they deal with non-performing loans is that you separate out the ones that are really dodgy, you place them in a separate investment vehicle or a separate bank, and then you sell them from that point onward. But you've taken the right bet, so you've already accepted the loss. That's the difference. If you only want to think, are they going to pay or not going to pay, it looks on the banks, things still look light. You still got the incoming money. So it makes your position look better than it actually is. But when in fact they don't pay, then your position immediately becomes a lot worse. If you accept that these things are never going to get repaid, you think this it now, you accept that you lost that money, you tell everybody that you lost that money, and here's. So the whole point about these kind of early warning systems and the resolution mechanisms in place is that you got the tools to recognize you're getting into trouble, come ahead of it, and try to deal with it before it reaches crisis. Yeah, well, if this is a process that is happening in individual banks,
right? The bank needs to have this plan. But it also can happen on a systemic level if you realize that across the entire banking sector in a member state, you've got these weaknesses. This is, of course, more difficult to do and requires the intervention of the government. Yeah. And the coordination with the central bank. What coordination with the central bank? What's happening in Greece at the moment is that they're trying new X. So they're trying to, because the level of non-performing loans is anything from 45 to 60%. But yeah, they're affecting the banking system without a bank. And they're thinking about the banks were trying to deal it all. They were unable to. It's been years that they haven't been able to clean up their balance sheets. So now the government is saying, we're going to set up a special purpose vehicle that's going to buy all these bad debts of the banks. It's not going to buy them at the 100%. It's going to buy them at a very significant discount. So the banks are clear that from all the, and then this bill sell them to investors. I mean, there's a market for distressed debt. Has a portfolio that contains a varied amount of risks, and there will always be demand for really junky bonds because they offer such a high return. So somebody will always place a bet. I will not take tickets. Okay, you're more likely we should buy an asteroid. I will still buy it. So there's a chance that you're gonna be lucky, and the bit of it your company is gonna pay up. And in any case, these products are, if this is a viable strategy. If the bank is running the risk of losing this in its entire, and in any case, the bank cannot wait because its capital position is weak. They send it off now. They get 20% of the money, write off the rest of it. They can move forward. They lost money, yes, but that's life. It's better off knowing that you lost it than realizing you lost 100% of it later on. It sits on this vehicle. The vehicle then makes derivatives out of it and sells it. There's always going to be people that buy it. And, how much they will pay for it depends. It could be that people are feeling better or the economy is picking up and there's unemployment is falling. So people are thinking, okay, maybe more students are going to start paying those loans. So the value will be closer. So the price goes up, the interest goes down. It's going opposite directions. The more risky something is, the cheaper it is to buy it, and the higher amount of interest it pays to entice you to buy. The safer it is, the higher the price, the lower the interest. So this always going opposite direction. So there's it, and ongoing problem there about how they can fix it. But part of the resolution system that you've got here is that you've already got a plan. You don't have to sit there and think about it at the moment. You already got something written down, communicated to the regulator that says that if we hit our triggers and our money runs low, then go to the special purpose vehicle, we take the write down, we kind of move forward. And the thing is, what you need to know is that once the bank is cleaned up from the dodgy assets, people are more willing to invest in, because then it's transparent. The greatest problem is not knowing what the position is. So you don't know the extent, you don't know the risk that you take, or the extent of the exposure of the bank. They pretend it's fine, but it's not. If they've taken the write down at the beginning and they acknowledge the problem, then you can assess the risk and you can make your decisions whether to invest. So you're going to get more people wanting to give you money than before. So acknowledging you're in a shit state actually means more people. So acknowledging you're in a shit state actually means more people will want to give you money than pretending that you're fine when everybody knows that you're not fine. So that's a little bit how the capital requirements regulation is putting in place a system. And we already talked about the European Banking Authority as the overall regulator for the whole of the EU. What we need to think about for a sec is how this relates to the ECB. Between the EBA and the ECB, as we said, the EBA is across the EU as a coordinator for all of these things, right? Capital requirements, the resolution, and the simple supervisory mechanism. The ECB is the regulator for within the Eurozone. But the ECB is and isn't a central bank, because we've got some stuff here that kind of look like a central bank, but not necessarily into it. It's by but also can do a variety of things, including subsidize the governments. Okay. Now, each national central bank can do this. How do they subsidize the government? They can buy government bonds. So the government is running out of money, it could either borrow that money in the markets. How does that? They issue bonds, right? And so price. If somebody wants to buy them, they buy. It could be that, the Italian government comes out tomorrow and says, we're making available 1 trillion euros in 10-year government bond. Who wants to buy some? And it buys. And it usually goes well. Usually you got the demand is for 3 trillion, but you only made available 1 trillion, right? But you don't want to borrow that much, so you got a specific amount of loan. But the markets usually, depending on how you set your price, the markets may or may not be willing to buy. So it's because till yesterday they were getting the 10-year bonds at like 3% or 4%. But who's going to buy? Well, the central bank could buy it. Then the central bank can do whatever you want. So if you are in the US, for instance, the Federal Reserve can buy treasury bills and subsidize the government for it. They can buy them at 0 interest. They can buy like a 100-year bond. It creates that money out of nowhere because it's the central bank, credits the government account with that money, the government kind of retains it at some point. It never retains it because these get then renewed into fresher bonds. So the government suddenly, instead of having to go to the market and borrow money from private providers at high cost, they can have as much money as they want through the central bank. Now, why doesn't everybody do this forever? Because, as you were telling us before, after a while it creates inflation. So, if you create too much money, what happens to that money? You create too much money, you give it to the government. The government passes it down to people. Infrastructure projects, benefits, higher salaries, or so on. So, salaries are going up. More people have got more money because there's more money spent. Because everything's going up, prices begin to climb. It's not usually government overspend and government increases in salaries left and right that creates inflationary pressure. Is that the prices of goods are going up for other reasons. The pressure is that the prices of goods are going up for other reasons. The price of petrol is higher. The price of raw materials and so on. So the prices of things to buy are getting higher. So there is demand for higher wages. If you're close to full employment, then it's difficult to find people to work with you for cheap. You have to pay them more money. Others are getting more expensive. If things need to get more expensive because you're paying people more money to make them. So if there's too much money pumped into the economy, all this money that filters in, it creates this constant increase in pressure, which is fine. I mean, normally, like a moderate rate of inflation is evidence of healthy economic activity. The worst thing that can happen to you is deflation, where things have become cheaper. That is disorganized to an incredible extent. The zero inflation is something that we live with for a while. That's not very normal. So the bank could create it that way. That's what the central bank will do now. Central banks now are independent, meaning that they keep an eye. They have a set of objectives. The objectives are and which will decide what is the appropriate thing to do, keeping into mind various economic indicators that primarily interested in keeping the inflation steady. So there's some degree of coordination with the government, but if the bank is independent and focused on one thing, which is price stability, which is inflation, the Minister of Finance, they ring up the bank, they buy some bonds or increase interest rates. But in the past, where the banks were in more close coordination with the Treasury, they were able to do it. But it doesn't matter. What matters is that the bank has this relationship with the government and this effect through the setting of interest rates for the rest of the economy. This doesn't happen in the Eurozone. In the Eurozone, the same way. Because the European Central Bank is prohibited from buying state bonds. So the European Central Bank cannot, this is the okay? Why not? Because to get the Germans to agree to let go of the Bundesbank. That they were very keen on to change the structure and to basically to take the low inflation, high productivity model that they had in government that was safeguarded by a bank where kept interest rates at a lot of control. First, they not want governments to be relying on this in order to subsidize their spending and do what they do. And this is reasonable. So if you did not have those controls, then you would have the bank kind of buying like crazy Greek bonds, Italian bonds, Spanish bonds. Then you would have the bank kind of buying like crazy Greek bonds, Italian bonds, Spanish bonds, subsidizing the spending. And this isn't healthy. It would cause inflationary pressures across the Eurozone in ways that the Germans really would not be happy with. Here and there, the biggest economy in the Eurozone, and the ECB was built upon the example of the central bank, so you could not have benefit without it. So that was the compromise. The compromise that we're setting up the system, so we have a central bank to support the common currency, but this is not a backdoor avenue you guys to subsidize yourselves for free, you guys to subsidize yourselves for free for it. From the weakness is that now you've got the central bank with some of the features of the central bank, not all of them, and when you get into crisis, you have an issue. And that's why they needed to proceed with the banking union, because they realized that we have a common currency of this in the Eurozone. We have a single market for services and capital. We've got all these banks operating in a coordinated manner and controlling a coordinated manner. But the moment the shit hits the fan, it goes down to national measure. From a point of dealing with crisis, a central supervisor that can make these transfers of money to support the elements of the system where they're in stress, and you could not have this the way the rules were operating. That's why they proceeded with the banking union, the blanket guarantee for everybody with 100,000 euros and all these things, and the stronger control across the whole thing. Out, and still a problem, is the state fund. So all this effort to compromise the system and to control banks and provision for the private system has progressed a lot, but the big problem is the state, and you still have national central banks that are not allowed directly to finance the state, the ECB that is not allowed to finance the state, so when the state gets in trouble, you have a weakness. Whether how a banking crisis of the private banks can affect the state depends in circumstances. In America, the banks unsettled the state because the banking system got into so much trouble that then the state needed to bail them out. So in the process of the bailout, that is happened to the UK as well, in the state to the banking system, and then a problem of a private crisis and a crisis of private indebtedness became a crisis of public indebtedness because it passed on the burden of the adjustment to the state. This is not always the direction of the problem. In Greece, it's the other way around. The banking system was better. But the banking system was overexposed for having both government bonds. So when the government was in trouble, it was the government indebtedness that infected the banking system. And then a kind of prolonged the recession, ruined the private debt as well, and kind of messed up and created all this non-performing loan. But in Spain and Ireland, it was the banking system that failed and affected the government. In Greece, it was the government that failed and affected the banking system. Yeah. But they're co-dependent, right? The thing is that these mechanisms, all nice and kind of progressing in order to deal with the private side of things, what is left problematic is the state side. And there is not going to be any progress in that, because any debates about kind of finishing the elements of the banking union by injecting kind of borrowing for the fall of the Eurozone that then gets distributed to member states, like bonds issued by the ECB that then are used. This cannot be done with the current treaty framework. It just is not allowed in the rules. And the things that they're doing at the moment, the ways to cannot fight and provide state financing through all these mechanisms without even violating what's the... Yeah. So all these things of this was the one. So effectively the ECB is struggling to do something that they're technically not allowed to do, and at some point they're gonna, because the Germans are bringing cases in the European Court of Justice against the ECB all the time for everything that is done in crisis measures, capital buffers. These are the amount of money in the Capital Requirements Directive is very significant in that. It is the amount of money that the banks need to have aside as easy, accessible cash when somebody asks for their money back. As we said, the banks give out more money than they've got. So this is the whole logic behind fractional reserve banking, but it creates a very distinct problem that if everybody comes and asks for their money back at the same time, the bank goes it sold. Right? When does any business go and find salt? When somebody has a claim and you cannot meet that claim. So in the UK, if somebody presents a claim of more than £750 and you cannot meet that claim, then your company will go into the insolvency process. And it doesn't matter how wealthy you are. It's a simple matter of cash availability. Right? I can have a house, a car, whatever you want, okay, all sorts of nice, expensive electricals in the house. If I cannot pay the electricity bill because I spend that money that month on buying fake or whatever, then it puts me in a personal bankruptcy situation. A company, this whole place here, you could be thinking, how can they go back if they've got all that stuff? If they've got a demand and they cannot meet it, so they don't have the cash, the short-term available cash to meet that, then they will be sold. That's how insolvency law works. So for the banks to be able to meet these temporary obligations, they need to keep some cash aside, easily accessible. Like what is easily accessible? Is that you put your money in investments that you can liquidate immediately and get the cash. So obviously there's a cost in liquidating investments, but you can get that money back. The difference with you for your personal finances would be having a current account that you can just go with your card and withdraw from the ATM, or having bought a year bond that you can't break. You have to wait for the end of the year to get your money. Or having a fixed term in bed in order to liquidate it now, you're going to suffer a significant error. Right? So how do you know how much money the bank needs to keep aside? Well, this is determined by the Capital Requirements Directive. This is done through the Basel Committee. So how do you determine how much, right? The legal expression of Requirements Directive and the determination of how much and in what form you give that money is through the Basel Capital Accord. The mechanism is number 3. So this is international. This is done by the Bank of International Settlements. It's based in Basel. What these guys do, they check exactly what would be an appropriate distribution of assets. They give you the right balance between easily available money, less easily available money, and multiple investments. So there's all these tiers of capital, and that then informs the investment decisions of a company. Because if you're a fund manager, in order to meet your regulatory requirements, you need to place your money in these proportions, these tiers. These tiers have got different risk profiles, and so they can make decisions for those. So for the tier that can be long-term riskier, you'll buy the junk bonds. So this is like a cake, okay? And you're obligated to have a slice from each level of the cake. And then within that slice, you need to pick investments that match that risk. So banks and big financial institutions that are regulated as banks. This is where this applies. This is people's, real money that we don't want to get lost. So these guys come up with the rules. They publish them in these accords. So they get, then a few years you get a new one that is updated. And then the national regulators, because well, the government will pass the laws and implement those, and the regulators make sure that it happens. Now, the people in the industry get that stuff because then it forces them. So once you come within this regulatory umbrella, it forces you to put your investments in things that pay in it. So if you need to keep easily available cash, if you don't feel you need it, right? You would prefer to put that money somewhere that pays a much higher amount of interest and more risk. So in order to meet these you don't have to, but you can. So the level of capital that you're free to invest in everywhere you want, then once you exceed those restrictions, then you will seek to find some junk bonds to invest in something that pays a bit better, so your overall performance is better.
So this is class 5. It's going to be a short introduction to financial services regulation. We're continuing our exploration of these things of what is the relationship between the state and the market in the field of financial services. Why are they attempting to regulate, in which way they're attempting to regulate, what are they trying to achieve, and what are the outcomes for market participants, and so on. Now, we've already spent some time in the last couple of weeks discussing the idea of regulation itself. Now, there's one thing that I want to raise with you guys, because I don't want to go back over the entire debates that we had previously. But it's the idea that regulation is not a new concept. But you wouldn't know this from the sort of debates that you've got going around. You hear people saying that all this stuff is new and it didn't exist before. The whole idea of market regulation and market support and all of these things came up in the 1930s after the collapse of 1929. And after that, before that, it was the kind of golden age of free finance and free markets. And somehow all this got diluted because people panicked with the stock market crash, and then they started kind of putting reams of regulation and impeding market actors from doing what they know how to do. And there's still a strong theme of thought that says people would be fine if you just let them be. That all these attempts to control the system, control entry, control performance, control exits upon failure, all this is just increasing costs for everybody, reducing choice, and making the system any safe. And, when you go to any kind of right-wing think tank, when you go and enjoy the catering at the Institute of Economic Affairs, as I told you, this is precisely the stuff that they can tell you. Some of it is kind of motivating debates about where people say that a freer environment for financial services away from the various regulatory strictures of the EU is going to allow the place to be a lot more dynamic and a lot more active. So it's all going to be fine in the end if you get rid of all this unnecessary regulation. Now, the interesting thing about all this is that it is based on a misunderstanding of the historical record. Things were not really that free before the 1930s. In fact, if you go and look at it, and if you look at the relationship between law, regulation, and market processes, things were very tightly controlled and regulated at that era, at the beginning of the 20th century, that people imagined was, free age of capitals. It was not at all. So if you go through the beginning chapters of my book that discusses the history of regulation, you have all sorts of controls. You have all sorts of controls ranging from how many bakeries you can have on one street, or how many bakeries you can have in one town, and at what price they can sell their bread. There were significant barriers to entry. All the professions were very tightly controlled. So all these things that we now assume that you will
go in the West and kind of open up shop and nobody would bother you. It wasn't like that at all. And when it started with sort of banking and banking services at the early stages, it was all also very, very technical. So what is this idea that it was all three? It's all a very useful fiction. Because if you can pinpoint the historical era that nobody has any living memories of, and you tell them it was fine back then, we were doing things that way, then it's easy to make an argument that we should do the same thing now, it's going to be great. Nobody knows what was going on back then anyway. But if you actually look at all the law and all the strictures that you had then, it was never free. So the only actual instance of a freer, non-regulated market is what you begin to have in the mid-90s. Not even in the 80s, because they started deregulating financial services, which started during the Reagan era from the mid-80s onwards, but the true point of deregulation was in the 90s. So, and for particular sections of finance, not for everything. But it wasn't that action. A short period in the 90s that things were loosened up. And what happened after that is that it hit a lot of risks that started sloshing around the system and then gave rise to a series of crises after that. So we can go back to debate, how much regulation you want or what you want to regulate and in what form, but it is a misinterpretation of the historical record to imagine that there was a free era of capitalism at some point that then got messed up and then there's an institutional trajectory that goes on from there. This stuff never existed. And of course, what you had in the olden days was not so much that people who could go around the controls, because you had people who operated above the law and they didn't care for any restrictions. So if you were a baker or you were a shoesmith, there were all sorts of controls as to what you could and you could not do. If you were building a railway, then you would just come and plow through a village and either kill the people who objected or pay them to go away. This doesn't mean that the regulation don't exist. It just means that state penetration and the rule of law was problematic. So I don't know whether we want to recreate situations where the people who've got the means can kind of evade the rules and everybody else is still subjected to them. So if you sat in a conference room debating on why should you regulate or how you should regulate things, and you take the decision that, looking at the numbers, the City of London, free from regulation, would generate additional money and contribute additional to taxation, so therefore the country would be richer, if that's the result of your calculation, then you might end up saying, like Ian Duncan Smith was saying yesterday, that it doesn't matter if all the auto manufacturing leaves the country, because they're not that a big contributor to GDP anyway, so if the city can make up for this. Okay. You could. At least this is some acknowledgement of kind of benefits and detriment of different policy balances. There's a lot of that material. So if you want to focus on a more abstract theoretical market regulation, you're going to find a lot of references over the last 3 weeks that would allow you to start some research on that topic. Otherwise, you can focus on issues that are a little bit more concrete. For example, various dodgy dealing in markets. What is the role of the state and the law in those markets? I mean, we've discussed a couple of weeks ago, perhaps 3 weeks ago, the idea of capital markets, stock markets, and all of these things. The role of the law, an even playing field for market participants. If you have a marketplace, and the function of a marketplace is a meeting point of buyer and seller, where prices are easier to determine and they are transparent, and also transactions are transparent. Inherent in the whole notion is the idea that everybody participates in this market in an even-handed manner, that information is shared equally and transparently.
Now, the outcomes are not equal because people have different capacities and aptitudes in interpreting this information. So you could spend your entire day reading the statistics and the numbers. And it could be that you discovered a pattern in something that other people have not seen. So you have an edge then. You can place yourself in the market, you can buy or sell something, and you can make a good profit because you something that's going on that other people have not seen. I'm not saying that you have outcome or that the outcomes are going to be the same for everybody. But the incoming information was the same for everybody. So all the spreadsheets were there. So, if I'm looking at the price of sterling on a daily basis, and I've been doing this for years, then I get a feel about how sterling is going to move depending on what's in the news every day. So if I'm operating in the Forex markets, then I could make good bets and earn money. But I'm making this on the basis of publicly available information. The fact that I'm cleverer or I spend more time or whatever it is, then the money that I make is my reward for all this effort I put in. What we don't want is people operating on not known information. So they obtain information that is not available to anybody else. We don't want deals to be non-transparent way, so people are trying to game the market in order to influence outcomes. And this is as a result of a negotiation between people in order to mess up with everybody else. We don't want fake providers or fake sellers or fake buyers. So what the function of the law here is to ensure that this level playing field is protected, both against outright fraud and dodgy dealing, but also as against uses of connections and information that is not transparent. This is extremely important. This is not the type of situation, and weirdly, people have got difficulty understanding this, like the idea of market abuse. Because, you're looking for a job, and your dad works in a good law firm, or your mom works in a good law firm, and your connections, you can talk to some people, and then you get a job. And that's how it works. There's nothing wrong with that. Yeah? You have positioned yourself in an employment marketplace, okay? But not on the basis of publicly available information, through connection. That, okay, we can debate whether it's ethical or not, but it's not something that is sanctioned by law. Trading, though, on a marketplace, in the controlled marketplaces, you cannot do it because your mom knows somebody who told her that this company is doing X, Y, Z, therefore you estimate that the price is going to go up and down. There is a fundamental difference between some stuff in life that you might get ahead for stuff that you don't know, that others don't know, that you obtain through sources and through connection, so like employment, like job purpose and so on. Totally different things, the same type of discussion, but in a regulated market. The law has taken the view, and the legislature has taken the view that you're getting a job because your mom making bets on shares because somebody told you that, something is not done. Maybe the fundamental ethical basis of the two is the same, however, the law takes a different view because the legislator made a decision that a level playing field in marketplaces needs to be defended with the force of law and very severe penalties. So all of that stuff is something that happens in the secondary markets. Why do we call them secondary markets? Because these are where the products and shares and financial bits and pieces get traded after the initial launch. So somebody meets the regulatory requirements and launches themselves on the stock market or makes a financial product available in an exchange, in some marketplace. So the regulator checks all these things at the beginning, that everything's correct. And of course, if you lie about it in your prospectus and dodge and all these things, there are very significant penalties. From the moment that the product is in the market, this control that I'm talking about is all the exchanges and all the movements that are happening thereafter in that time.
You cannot be making transactions on the basis of things like information that you got through contact to contacts that nobody else knows about.
Yeah. You can rely on the evidence of your own due diligence and research, but your starting point needs to be the publicly available information. Now, how is this actually reflected in the law? You get a lot of things that cover market abuse, and market abuse is a blanket term that covers all sorts of dodgy activity in marketplaces. People are more familiar with inside information, so it is easier to describe these things if we're talking about inside information. What could be inside information? You got a mate that works in the factory in China and makes the iPhones, that they tell you that there's a big problem with the new production line because the components just don't come together and it doesn't work. So we estimate that there's X amount of orders for the new thing. They won't be able to meet them. And they say, wow, I'm just struggling to deal with this technical issue. You call your stockbroker and you say, take a short position on some Apple shares because they've got coming up the production line. When people know about this, then they're going to panic and the share price is going to go down. So what you do is that you make a contract that says, I'm gonna buy the shares in 2 weeks' time, okay? Because you know that the price is gonna drop. So you have, the way you take a short position is that it's a promise to buy certain shares in the future. Yes, yeah. So you buy, because you wouldn't buy them now, but you've got the contract that says you buy them next week because you know that the news will have come out that the price is lower next week. So there's a lot of kind of deals that you can do, anticipating movement of shares. But the important thing is not what deal. The important thing is not what deal you did. The important thing is that you chose to enter into a transaction because of information that is not is inside information. It's privileged. Nobody else knows it, and they're not allowed to know it. And moreover, not only you cannot transact on something, but the people themselves in the business cannot transact on the basis of the information that they've got. Insider dealing and manipulation are not the only types of abuse that we're looking at. All the regulatory framework that's been developed to defend this level playing field is dealing with a number of things. Now, all of these things are defined at EU level, either through directives or regulations, and then they find expression in national legislation in a variety of ways, but the treatment is meant to be consistent. So if you're looking across the EU, if you're looking at these things, then you're going to find corresponding instruments in each nation state that gives effects to these things. As I said, insider dealing, you guys can understand equally a politician that tells somebody, we're just about to ban smoking, and then you go and sell the shares in the smoking company again. That's also not allowed. You deal with something, the privileged information could be coming from within the company, could be coming from a state entity, could be coming from the regulators themselves. But what are other types of market abuse? Like a pretty one is the LIBOR scandal. Now, it's important to note as well that these things got criminal consequences. So it's not like you get a penalty for having done stuff wrong. You can go to prison for it. Why does the law impose criminal penalties on some stuff like this? Because people are afraid of going to prison. So if you're very rich and you tell me that I'm gonna put a fine on you, I might be thinking the level of the fine is also determinant on people's perception of whether they've done something wrong. If I park the car here, it's to buy the ticket to park for the day is £10. If you park illegally without the ticket is £60. I could perceive the £60 as a penalty that I've done something wrong and here's the fine, or I could perceive it as this is the price that you pay if you don't buy the ticket in advance. If you're very rich and a penalty is imposed upon you, if the penalty is not significant enough to cause damage to you, you might be thinking that this is not in fact a penalty, but this is a price that you have to pay for doing it in a different way. So these are the rules that you follow. If you don't want to follow the rules, then you pay this extra cost. It's like, going on the express queue on EasyJet or whatever it is. Yeah. Now, if you in order to demonstrate that this stuff isn't something you can pay your way out of, that's why you got criminal penalties imposed, and then you get a criminal record, you get dragged through the courts, it looks terrible on your CV. And ethical offenses. Plagiarism is an ethical offense. So if you get kicked out of your course for plagiarism, they might jeopardize your chances. They might jeopardize your chances of joining the bar in certain jurisdictions. So you're, right, the LIBOR scandal, wonderful things. LIBOR, as we said, is the London interbank rate, is how much interest the banks charge each other to lend each other money, and it's a benchmark rate, meaning that other people structure their products by reference to that way. That you can get the mortgage, and it will say we will charge you 2% above the Bank of England rate. So that's what makes it fluctuating. Their 2% is always 2%, but because the Bank of England rate goes up and down, it usually goes down, but hey, then that makes your rate variable. So you could LIBOR instead of referencing the Bank of England. A benchmark rate like this has got consequences across the economy because everybody is based on that. The LIBOR rate was supposed to be the product of genuine competition, the banks lending each other money and what would be the appropriate rate. And as an open market, in the same way that the exchange rate of a currency is determined by millions of transactions on that currency on a daily basis by a variety of unconnected buyers and sellers. But it wasn't. Okay, these guys used to kind of meet together at the private members club and kind of go LIBOR tomorrow 1%. That's not good. Because why is this not good? Because obviously they wouldn't set it at lower rates than it would have normally been. They were setting it at higher rates. People are not gonna organize to offer it something cheaper than it would have been in the market on its own. They were organizing, so they were setting it more expensive. So as you can imagine, not only the lending between the banks was at inflated prices, pretty much everything in the economy that was referencing that rate ended up being at inflated prices. The consequences of this manipulation are felt across the economy. So this is terribly bad. And of course, the banks involved, they said, we didn't know anything about this. It was a few rogue traders in the private members club. They choked on their cigars and accidentally agreed to the rates for a few years. And now, we need legislation that covers these types of manipulation. So it's not only insider dealing, but other types of market abuse. This, not open competition and chatting about things that then they've got negative consequences on everybody else, is a good example of another type of market abuse. What happened with this is that the banks got prosecuted, the people involved got prosecuted, some of them got convicted. LIBOR as a whole is ending. So it's going to go for another 2 years, and then the bit of anxiety in the industry because you're going to have a lot of legacy contracts that are referencing LIBOR. So the question is, what do we do with all the old contracts that are based on LIBOR, and how all these contracts need to be amended and now reference something else because the benchmark does not exist anymore. So, the industry is a little unhappy about, but then this change would not have come about if it weren't this horrible instance of market abuse. And this is reflected in the European legislation. What you see here, we've got the market abuse regulation. And we've also got market abuse directive. These things are dynamic, meaning that they keep changing all the time. Why? Because financial markets are dynamic. Because different products come all the time, different ways of doing business, different things. And the regulator is playing catch up with this, of course, but if you've got an innovative industry that comes up with new products all the time, you cannot pre-estimate what they're going to come up with next. So it is inevitable that regulation is trying to catch up. But the tools that we have, the structure of the system is supposed to be there, and it will encompass a variety of new situations as well that they were not in existence at the time. Inside information is the thing that is most common, that you're gonna be able to read a lot in your materials. What is significant is the definition of who is an insider. If you're looking at insider information, and you need to remember that insider is the person who has got the information. So the person in possession of this privileged information is considered an insider. If it's passed on to another party, then that other party also becomes an insider. So it's the possession of the information that determines whether you're an insider or not. You cannot say, "Oh, I don't work at the bank. Somebody told me at the gym, so I'm cool. I can go buy some shares." The fact that the information has been transmitted to you brings you within this protective cycle. So you cannot neither transact nor tell anybody else to transact. Now, another aspect of this structure is consumer protection. Should the consumer have some responsibility for this or not? To what extent is it the job of the state to protect people from their own actions, or should we rely more on financial information and education in allowing people to kind of navigate the labyrinth of financial products? Here you've got the distinct difference of approach between continental and US jurisdictions. US, they have moved towards consumer protection significantly since the crisis, because America was very much a place that said, we control entry, we control the provision of information, but once the information is there, it's the job of the consumer to kind of figure it out. So there wasn't a lot of protective mechanisms in place, meaning products should not be made available because the state or the regulator makes the decision that these products are too risky for certain types of buyers. Right? So they didn't have a lot of that. After the crisis, they did have more of that. Now it is in the process of getting dismantled. What they had throughout was an emphasis on financial education. Now, I've always taken a dim view of this. I think that it should be the job of the state to control the variety of products and the provision of products, rather than educating people that some things are too risky. These things are impossible to understand. And people don't have the time or the inclination or the background knowledge to navigate. If I want to buy that ISA, right? If I want to invest that money in the tax-free account, I can get one that's just a simple bank deposit. You put the cash in, the cash sits there, pays a certain amount of interest. I could buy one that is linked to the stock market. That's it. Right? I don't have the capacity to distinguish now between the various products that are linked to the stock market. And I don't want to know how the fund manager is going to deal with their fund. It is not a matter of educating me as to how products work and what are the variety of products and what are the risks involved, and then to get me to decide the level of risk and reward. So should I get ISA number 1 that invests in really dodgy shares, or should I take ISA number 2 that invests in shares, or should I take ISA number 3 that's a peer lending thing that kind of lends to tramps in order to kind of break into cash converters? Like, I don't know, okay? I shouldn't. The Americans have taken the view that financial education needs to be something that needs to filter through the schools, through all levels of education and so on. People in Europe, that just should not be allowed. You should not have short-term loans that charge 3,000% interest. And that's it, because it's just bad for you. It's too risky. And here you've got some inconsistency between various member states, right? In the UK, they've taken the view that this was filling a need in the market. Okay, it's filling a need in the market. Yes, there are always people who need to borrow money and nobody's going to lend it to them because they're too risky. So the logic of the government was that if they go to loan sharks, then, they get really extortionate rates, and if they cannot repay, somebody comes and breaks their legs. So this is not nice. It should be better if it's part of the transparent system. So instead of getting it from somewhere down the corner, you go to Wonga.com and you get your loan there, and Wonga is not going to come and break your legs. It's just going to come and take your kitchen and your microwave. Now, a different attitude to this thing would have been to say, no, we will not allow anybody to charge 3,000% interest. We will not allow DFS to sell the couches at 300% interest, because nobody really needs a couch that badly. All of that stuff is the debate as to should you inform the consumer and then allow riskier products, or should you prevent the riskier products, and how to figure out that they're risky or not. This is a policy decision, and they've taken different views. In Europe, which is the framework that we're talking about here, they're more prescriptive, and you've got a distinct move from the caveat emptor idea, which is buyer beware, to consumer protection. So we don't let it to people to make their own decisions from a variety of dangerous products. We try to eliminate the more dangerous products out of the way so they cannot actually get them. And then we give them a more restricted choice, and then their knowledge and their choices and their will comes into that, but it's a contained basket of options. It's not in the same way as a mobile phone. You go into a store, you get a phone, some of them are nicer, some of them play Asphalt 8, some of them play ping pong, right? But none of them are gonna blow up. So you do not have the choice to buy one that is really cheap, is really nice, but might actually blow up in your pocket. That is taken out. It's not a matter for you to assess risk and reward. Just the regulator thinks that it's true. All this is then expressed through. Okay, so we've got, this is the sort of network of thing that is now consumer protection. It's the products not for participants in the market, but for actual consumers, and all of that again at European level filters down to people. Now, in national law, as I said, we've got a reflection of the same things. If it's a European regulation, then it's got direct effect, so it's got direct legal consequences at member states. If it's not a regulation, it's a directive, then it needs to find its national interpretation. So you will need national legislative initiative in order to implement it in national law. And these are the key provisions in English law as to how these things operate. Insider dealing and market abuse directives are interpreted through those. So you got the Criminal Justice Act of '93 that contains the kind of stuff that sends you with handcuffs to the back of a van. And you got Financial Services and Markets Act of 2000, the thing that kind of had set up the FSA. And the new version of that is the Financial Services Act of 2012, which is the post-crisis regulatory tool. And it contains all this information about what are various offenses that have to do with market abuse, etc., etc. So today we have the opportunity to talk about the bank-customer relationship in a little bit more detail. So you had all the kind of big theory things about how the regulatory system for banking and finance hangs together in national and international domains, and now you're having a bit more detailed information about practical things, including, what actually means to be a customer of a bank and what is your relationship with the bank in that respect, that we will do today. And then we talk about payment systems, we talk about certain financial products in a bit more detail, and so on and so forth. So today we're going to talk about how do you figure out if you're a bank customer and what that means, the relationship between you and the bank, the duties that you have towards the bank and the duties that the bank has towards you, what happens when things kind of break down in some fashion. And if we got the time or the inclination, we can talk a little bit about fairness in the idea of a banking contract. And is there an obligation that they fail, or how do we judge that there is? What is a bank? You will remember that we had seen a little bit of a discussion about Lord Denning in United Dominions and Kirkwood, that he was trying to come up with a definition of what is a bank. And he found that's relatively difficult because banks do a variety of things, not only now obviously they do a variety of things, but they already did a variety of things in the early 60s and mid 60s that this case is coming from. So Denning was attempting to identify certain key characteristics of a bank, of a banking activity, but also a banker. What are the characteristics of a banker? Wow. Soundness, stability, probity, somebody who maintains a good reputation for the company, the ability to deal as an intelligent commercial person. So all this idea that the banker is somebody that you entrust with your money and is a person of ethical standards and appropriate commercial ethics and behavior. This is what you would want it to be. You don't, the characteristic of a banker is not the kind of random fraudster, but after what happened in the financial crisis and everything that's been going on since, and the various prosecutions left and right for these people doing dodgy stuff, it really sounds funny to describe the banker as somebody character, soundness, stability, and probity. Of course, we would want them to be that way, and the law should imply a standard like this. What is it that the bank is supposed to do? The key function of the bank, as we have seen in the past, is the idea that it collects deposits and then makes loans. So the core of the banking business, the core of the banking is taking of money and then making it available. And the core characteristics of the banker, these kind of rather ethically or morally linked as to their behavior. It's been present in the law for a very long time that you cannot carry the title of banker, of a banking institution or of a bank, unless you have passed through a process of authorization by somebody else. So the very title, the functions that come with bank are subject to authorization from the relevant national authorities, and it's not something that you can set up on your own. So you can choose to call yourself a variety of things, but you certainly cannot call your business a banking business unless you have specific authorizations. And if you're caught engaging in the business of banking in the way that it's defined now in the various instruments without having obtained these authorizations, then you get into a lot of trouble. Is PayPal banking, are payments facilitators banking businesses? This is something that exists now, so it's something that gets fed into the regulatory system and the definitions of these things. You did not have this type of payments facilitators that were working independently in the past, right? But you do have them now because online transactions allow you to do this. So that the types of services that banks provide today, apart from deposit taking and lending, have to do with a lot of things that do facilitate the transactional aspect. So they do a very significant provision in allowing you to use means of payment. So all this business about debit cards, credit cards, and so on, now it is as significant a part of the banking business as the traditional idea of taking deposits and then making out the loans. And also, the banks now are providers of financial advice and a variety of financial products in a variety of marketplaces, including insurance products and things like this. Who would be considered a customer, right? We have a bit of an expanding definition here of who comes in contact with traditional banks, traditional banks, and in addition, the more modern types of activity in financial markets. So that to discover who do we consider to be their customer and what are the sort of obligations that are built around this. If you are engaged in what is known as a regulated activity, the regulated activity of accepting deposits, for instance, then you need to comply with certain standards. Now, these standards were industry created and industry based traditionally, but after the financial crisis, there was concern as to how these types of self-regulation are sufficiently robust, so now they have become more integrated into as well. So now we've got what we call a banking and payments conduct regime. This grew out of things like the banking code. You used to have the banking code before the crisis that set out the duties of the bank and the expectations that the customer can have out of a regulated banking and the expectations that the customer can have out of a regulated banking activity. So this grew up from the banking code that was run by a banking code standards board. It grew up to the banking and payments conduct regime that is now regulated by the Financial Conduct Authority, the previous regime. And all of these things are meant to give information both to the banks as to how they're meant to conduct themselves and deal with the customers, and also to tell the customers what to expect in a way that complies with the regulatory framework, things like payment services regulations, payment services directive. There's a lot of European Community law that comes into this thing that informs the nature of this relationship. And under the Payment Services Directive, you've got the Financial Conduct Authority that is responsible for all of these rules and passing them down into the banking system and then checking how the banks are actually operating. So they flow down the requirements, and then they also have a monitoring role as to how the banks are responding to all of this. And you have now something that is called the Banking Conduct Business Source Book. This is the entire this regulates the entire regime of deposit taking, and it comprises of a source book for the banking system, principles of business that are created by the FCA, conduct of business requirements, and specific information about how electronic money transactions. And this is a source book that applies to everybody that is involved in the traditional banking activity of accepting deposits from banking customers in the UK. Now, these are EU regulations, but they are, of course, implemented at national level, and they're checked by the national regulator. A banking customer is a consumer or a small enterprise or a charity that has an annual income of less than 1 million. These rules that I said, the Banking Conduct of Business Source Book applies to dealings with consumers. Why is there an emphasis on consumers? Because businesses can take care of themselves. The assumption is that that's why a micro enterprise will be considered a consumer. Because if I'm on my own or with a couple of other people and we've got a private limited company and we go to the bank to open a bank account, this might be a business bank account for our shop, but in fact we don't know any better than what we know for our personal bank. So a small business that doesn't really have any support behind it will operate in the same way as a traditional consumer. So all these regulations and the directives, they take the same view of a private individual for the private banking and and also charities that have a low turnover. Again, they don't have the know-how or the legal and accountancy support behind them to do more complicated things. All of these things are to protect the consumer. Why do we not need the protection for the businesses? Because the businesses, if they're bigger, they got lawyers, they got accountants. If they're bigger, they got lawyers, they got accountants, they got financial advisors. They get different types of products that are also coming with a lot more information or different types of information from the banks. So they're in a different position to make up their minds, and they don't need this foregrounded protection controlled by the argument to be had as to whether there is such a thing as a sophisticated counterparty. Because we have found in the financial crisis that a lot of people who supposedly knew what they were doing, they didn't know what they were doing and they lost a lot of money. So there's a kind of stream of the literature that says that nobody really understands what's going on and the distinction between consumers who don't know and don't care and they cannot be well informed, therefore they need to be protected, as opposed to businesses that do know and they have the interest, is really a false distinction. Because the losses in the financial crisis prove that even the top people that had invested to figure out and to know, they didn't do the due diligence, they didn't understand what they were doing, which led to massive losses. So if you take this view that there isn't really such a thing as a sophisticated counterparty, then this would lead to an expansion of the protective regulatory framework to everybody beyond consumers. But of course, this is not what's happening at the moment. At the moment, maintain this distinction between customers, a retail sense, who don't know what they're doing, and businesses who do know what they're doing. It might be a fiction, but it's the basis on which the regulatory system is split. Perhaps the task would be too large, or it would be too restrictive if you were trying to adopt the same kind of paternalistic protection standard, to businesses as you apply to consumers. This is something to debate for the future. So these rules, as I said, they protect, for the time being, consumers, micro enterprises, and charities. They deal primarily with the core business activity, and they also is a big problem. Because there's the assumption that things that are done face-to-face, physically, the consumer has got the opportunity to understand better the product, but the things that are done on the phone or online, you've got much less opportunity to discover, and there's much more emphasis in you discovering on your own what's happening, which then means that there should be more protection. There is all these instruments. The source book contains guidance on how to communicate with banking customers, how to communicate financial promotions, how do you stay on top of the requirements of the Distance Marketing Directive and E-commerce Directive, the information customers, if you're a bank, what counts as appropriate information and what sort of statements of account you need to send them, how you can run a prompt, efficient, and fair service, what happens if accounts are moving, what happens if something goes wrong at some point, what happens if accounts have been lost or are dormant, and how do you need to communicate with people in those cases. What happens if you got unauthorized or incorrectly executed payment? You protect the customer in that case. What do you deal with cancellation, the right to cancel, and the effects of that cancellation? So all of these are contained within the source book, and this is the real stuff all the time. And there's a lot of as a consumer as a result, because if they don't do that stuff, then you would complain internally with the bank if you think that they've done something wrong. When you finish an internal process of complaint, then you have access to the ombudsman, the financial services ombudsman, when you go and complain about it. For everything that doesn't go right, then you should go and complain. But what I'm trying to say is, these things are there for a reason. Mistakes will happen, either because you're dealing with somebody who's not nice. Maybe they're not nice and they're just trying to scam people and they don't do their jobs properly, or it is a genuine error. These things, the framework as to how you should deal with these things, and then you should make use of all the tools that you've got available. And in the end, remember this, if the amounts are low, they will always give you what you're asking for, because the more it escalates, the more it increases the costs for them. Because if the ombudsman comes against them, then you're going to take them to court and they're going to have to instruct a lawyer. They instruct a lawyer, they're going to pay £400 an hour. So is it really worth, once you brought it all the way up to the ombudsman, to run the risk of losing and then having to go through all that expense, or giving you what you're asking for? Now, of course, if your claim runs in the thousands and they really think that they have done nothing wrong, then they will pursue it. But 99% settles, even for things that have got no merit. At least my cases all had merit because they had done something wrong. The matter was the calculation, whether they accept my calculation or not. Other cases that I'm aware of, people have got no merit whatsoever. They just harass them, and they will always settle. But you wouldn't be able to do all this if you didn't have the system there in place to give you those tools as a consumer. The vast majority of businesses will rely on the fact that you just can't be bothered, or you don't know about any of these things, so they will just wait. Processes take 2-3 months. Because, I make a complaint to my travel insurance. They say, yeah, it's going to take 40 working days. 40, it can take 400 working days. I'm not going anywhere. Okay? But normally most people will lose interest. By the time or they will have forgotten about it or lost the evidence by the time the response comes. Yeah. Okay, so we've got all these things here. And then we've got the FCA's principles for business, as I said, and these escalate from the consumer to the business, because they're not all these standards and all these expectations of behavior. They're stricter for consumers, but they also reflect on behavior towards businesses. So I don't want to give the impression that the business-to-business side contract is completely uncontrolled and they can do whatever they want. No, there's a reflection of these standards, but with the understanding that businesses are in a better capacity to make their own deals. And then you got the electronic money regulations, which is very significant because it has to deal with all the payment services and all of that stuff that we're going to see in our next classes. Now, let's go to the relationship between the bank and the customer. Now, the basis, if you needed to locate what is the basis of the relationship is effectively a contractual one. Okay, I mean, you are a customer of the bank because you have signed a contract with the bank to arrange certain services to be provided to you. So if you see the decisions in early cases about this, like the Swiss Bank Corporation case, 1921, then the court saw the banker-customer relationship as a single contract. Okay. On the other hand, one of the other judges in there saw it as a relationship of creditor and debtor, not necessarily a contractual one, but as a relationship of creditor and debtor, then it goes beyond what you have in a contract. Now, what is the difference? The difference is that if you view it simply as contractual, limited, the contract says what it says, and then it is a matter of interpreting the provisions of the contract, interpreting the intention of the parties. However, if you focus more on the debtor-creditor relationship, then a lot of additional requirements come from the law of equity and from the law of trusts. So then it becomes a relationship that is uneven, where the customer is reliant upon the bank and the law implies way more things in order to protect the customer and to make this relationship operational, because it is always assumed on the debtor, obviously. Yeah? So we've got this interplay between understanding this as purely contractual or taking the equity trust law implications of this relationship. The modern interpretation of the rules brings the two together. The beginning of your relationship is contractual, but not everything that's meant to happen and will happen is contained within the contract itself. Both because a lot of things are implied into the contract by operation of law through the common law and all the understanding that was got of the equitable dynamics and also all the regulatory assumptions and implications that are coming in through modern legislation. Are you guys familiar with the distinction, the key distinction between law and equity in English law? So these used to be different systems of law that were operating in parallel. So you had courts of law that were dealing with the traditional common law as developed by the courts, and then you had the courts of equity that were run by the king, where the king had discretion to overturn the decisions of the common law courts in order to achieve more fair outcomes. Because it was recognized that a strict application of the rules sometimes led to unfair outcomes, and it was within the discretion of the crown to lead to different results. So eventually, this led to an entire body of jurisprudence that created its own legal system. So, and you had these working in parallel. You had the courts of law came together at some point in the late 19th century. And from that point onwards, the courts look at both streams of jurisprudence to reach outcomes that are consistent, but also outcomes that are fair. That's why we now talk about, The contract bits are the agreement bits that are the traditional domain of the common law, but also impressions as to fairness, power dynamics, inequality of power relationships, and all of that stuff are helping us understand the contract and interpret it. But these are coming from the equitable bit that had to do with fairness in contracting, not only contracting but also in the outcomes. Specifying, therefore, what are the duties of the bank. All of you, I imagine, have bank accounts, or you have lots of cash stuffed in your pockets. Now, what are the key obligations of the bank? They've got 4 main duties. It is to comply with the customer's instructions for operating the account. So if you tell them to move money, they're obligated to move the money. To comply with... So if you told them to make a payment before and you change your mind before the payment has taken place, then they're obligated to stop it. So if you want to stop a direct debit, you want to stop a standing order, you want to stop a check that's already been issued, they're obligated to stop this for you. They're meant to exercise reasonable care and skill in operating your account according to your instructions, and they're also obligated to treat the customer's information as confidential. These are the key duties of the bank, and they're specified by looking at, well, the customer's mandate is this obligation to respect the customer's wishes as to what they want to do with the account, and the majority of case law on this has to do with checks, because obviously, all this case law is a bit old, and up till, I don't know, the mid-2000s, checks were the primary way in which people made payments in and out of accounts. Yeah? So the basic obligation of the bank is to honor a check on presentation. And once they've honored the check, then they take the money out of the customer's account. They're only obligated to honor the payment instruction if there are sufficient funds in the customer's account, or whether the check is guaranteed by some other means. Back in the day, they used to issue debit cards that said it's a check guarantee card, meaning that if you put the number of the debit card at the back of your check, then the bank will pay out up to the amount that the check guarantee card was good for, usually was £100. So the bank was accepting to honor that check regardless of whether you got money in the account, because you put the debit card number at the back. Yeah. So within those requirements, so either if the check is not guaranteed by something, they will pay it if there is money in your account, if there's available balance, or they will pay it if you've provided some sort of guarantee. It's not up to them to second guess your check. So you write a check to, sex store, and the bank manager receives the check, and they go, oh man, Jens has been to the sex store again. This is really not proper. I don't think we're gonna pay this, right? They don't have the right to do this. So nobody asks them what they think about your transactions. If they are under a strict mandate to honor the payment of the check if you've got sufficient money in your account. If they fail to do so, then you got an action against them for breach of contract and what? Defamation. Yes, because if a check bounces, then it affects your business reputation. Next time I walk into the sex shop, they're gonna go, oh, that's the guy that gives us the dodgy checks. Don't give him any of this stuff, right? So it can have very severe consequences. So your responses are breach of contract, to claim back whatever losses you've suffered out of the transaction not working, and an action in defamation. Now, the losses should be significant. If you're putting down a deposit for a house, for instance, and the check bounces, that you lose the property, you might lose money. I mean, you have invested quite a lot of money and effort in doing this. If you're, you're the estate agents and you need to put down a deposit and the check bounces, then you don't get the place and you don't have anywhere to stay. You need to stay in a hotel for the next couple of weeks. This is like a significant expense. So a claim for breach of contract means that you get a stick to recoup whatever losses that you got arising out of the bank's action not
illegitimately, not legitimately, not to honor the check that you had money when you had money in your account.
Now, also, same stuff goes about the countermand, which is your ability to stop a check that you've issued. So you've issued it, and you hear on the news that morning that the chain of sex shops where you sent the thing has gone into administration. You think, shit! Because if they get the check, then it goes into the administration liquidation process. I'm never going to get my stuff, and then I'm probably never going to get the money as well. So quickly we got to cancel it. Or probably never going to get the money as well. So quickly we got to cancel it. Or you recognize that you've been scammed. Or you change your mind, right? And then you want to battle it out with the shop that was going to get the check as opposed to the bank. Okay? But the bank, again, they should not, before the check has been paid, you got the right, or whatever any payment has been authorized, you got the right to stop it before it's actually paid. Now, within all of this, the banker has a duty of care. Now, this is a wide-ranging obligation to exercise reasonable care and skill in carrying out the part of the contract that belongs to the bank. And this extends over the whole range of banking business, not just paying the checks, but, we usually talk about payments of checks because it's the most easy example from the case law. It is implied both at common law and through statute. For instance, we had the Supply of Goods and Services Act of 1982 that implied a duty of care and skill in the provision of services in Section 13. Now, you can still use this, but it is also reflected in the Consumer Rights Act. So anybody, any service provider, what is it that prevents coming in here and talking about the weather? Duty to exercise reasonable care and skill stems from primarily this obligation on all service providers. But we've got a very specific interpretation of this because the duty to exercise reasonable care and skill could conflict with the duty to comply with the customer's mandate. So if the bank thinks that the customer is getting scammed, should they say that they're not going to honor the transaction because they have a duty to run their business properly and not to facilitate fraud on the customer and so on? Or should they respect the customer's mandate, no questions asked? That's why this has become a problem. Now, the courts had the chance to discuss exactly how this works out in cases like Lipkin Gorman, is that he had a firm of solicitors, and the firm of solicitors was allowed to write checks on behalf of a client. So they had the right to operate the customer's account. Now, slight problem is that one of the lawyers in there had a bit of a gambling problem. So he started writing checks in order to finance his gambling habit. And now, they bring action against the bank. Why against the bank? Because the bank's the one with the money. They don't have any money anyway, so you want to sue somebody that can actually afford to compensate you. So they come after the bank, and the question is, the argument is that the bank failed to fulfill its duty because it was aware that there was something dodgy going on. Now, what the courts will do is look at the circumstances of the case, look at the acts complained of, and ask whether in the circumstances a reasonable banker, knowing this information, would have been put on note that there's something going wrong with the customer's instructions. And if the banker is put on notice, then they have a positive obligation not to carry out the transaction, but to communicate with the customer to verify. So the banker cannot hide. If it looks like there's something dodgy going on that they have become aware of, the banker is under an obligation to communicate with the customer not to authorize the transactions. If they do authorize the transactions, then it becomes a problem for the bank. A variety of ways. This is, apart from other types of legislation, this is why the bank will call you if they think that there's been actions on your account that don't look right. So if suddenly there are transactions on your debit card here and in South Korea, and you have a coffee at Starbucks in London in the morning, and then in the afternoon you got the purchase of a computer in Korea, and then you got a TfL charge in London, and then another charge in Korea, then the bank is put on notice that there's something weird going on with your account because you cannot simultaneously be here and in Korea. Prove that the transactions are right. Sometimes this leads to errors, right? Sometimes they will block your card because you've traveled abroad and they just think, oh, there's something weird going on, and then you find yourself with a card that you're not able to operate abroad, and that can be a bit of a hassle. That's why you should have multiple cards when you're going abroad. Sometimes they're just stupid. I send some money from one bank account to another bank account. Okay? The name is the same because they're both my bank accounts. The money never makes it to the other bank account. The money never makes it to the other bank account. Nobody calls me. I call the bank when I realize a week after and say, what the hell happened? I sent £200. It's like, oh yeah, the transaction was flagged as suspicious. So instead of telling you anything or returning the money that it came from, we put it in a secure account. Yes, because it was a small amount, so maybe I would not have noticed, right? And what would happen afterwards? Like the money would come back. But if that money, you know what the problem is? If that money was meant for a payment, because I moved that money for that account because I used the debit card of that account to pay for something, then if the transaction didn't go through, then I probably would have lost or incurred additional expenses. Then, who would I sue? Well, that's a bit tricky because they did not comply with my mandate. The receiving bank is going to say we were put on notice of a suspicious transaction, but then they didn't follow through. So I think they breached their duty of care and skill by not communicating with me to ask me what's going on. So what they should have done is return the money or communicate with me. Keeping the money and not saying anything is a violation of their duty. Yeah? But it will become tricky as to who do you go after. You go after the bank that sent it or the bank that received it, and exactly, what are the circumstances and what are they going to say. And for them to say that we're put on notice of a suspicious transaction, therefore we don't do anything, that's a problem. Now, crucially, we also got the banker's duty of confidentiality. In addition to saying that you have an action for defamation against them if they don't respect the customer's mandate, and your checks are bouncing or your card gets declined, and that can cause. This can have effects on your business reputation. Apart from being embarrassing at Tesco's, okay, you try to buy like a cake and the card doesn't work. That ever happened to you? Most of the time it happens because the bank's system is down and then they cannot process. We had a problem with NatWest bank cards and petrol stations. For some reason, the petrol stations wouldn't take, it was which brand, like one particular brand of oil company. The petrol stations could not process the NatWest debit cards. So you fill in, you're going to pay, the card doesn't work. What do you do? You cannot take the fuel out of the car. They won't let you leave because you haven't paid. Yeah. But anyway, for that, so they have a duty of, in addition to you being able to sue them for defamation if they don't respect the mandate, there is a duty of confidentiality. Now, this is very important. The bank is not allowed to say anything about your account, your status with the bank, anything to a third party without your explicit consent. That's why every time that you need to be credit checked when you're applying for something new, they ask for explicit consent that they're allowed to ask questions about you to appropriate authorities and so on, so they can credit check you. The only exceptions that you've got to this are, and this comes from the case of Tournier here, the exceptions are where disclosure is under compulsion by law, so they communicate information to the revenue or to the authorities as they're checking for kind of transactions, money laundering and all of that stuff, where there is a duty to the public to disclose, but that again is subject to specific requirements, where the interests of the bank require disclosure. That's subject to discussion, but it has to do again with them fulfilling the regulatory requirements, or where the disclosure is made by the express or implied consent of the customer, which when, for instance, you accept to be credit checked and then you tell them that they can ask the banks for some basic information about your credit worth. Yeah, how an example of how Michael breaches duty. You call the bank and you say, I've got some checks in my name from this guy who is a business that is registered with your branch. Are you open at 3 o'clock so I can come and cash in those checks? And the person on the phone says, yeah, sure, but in any case, there's no hurry because these guys, their checks are bouncing left and right, so you try and cash them in, you're likely not to get anything. That is a breach of the banker's duty of confidentiality. Okay? You're not allowed to say anything unless you fall within these specific categories that you've got anything about somebody's business transactions, availability of funds, and all that. Now, do you have any duties as a customer? Well, you do have some. The key duty on you is to exercise the reasonable care and skill when executing written orders. For example, when writing checks, for instance, so as not to mislead the bank by your instruction being ambiguous or facilitate fraud or forgery. So when you're writing a check, there's a way that you write a check. You don't put 1 at the beginning of the line, and then you write 1 handwritten underneath, and then you put 1 in the box at the beginning of the box, because somebody else could come in and fill in the zeros. So the 1 has become 1,000 or 1 million. And also your instructions are meant to be specific. Now, there's less opportunity for you to make mistakes here with online banking, because if you don't input the information the way that it's meant to be there, then it won't work, and you won't be able to complete the transaction. But if you're trying to send money to a friend of yours because it's their birthday, and you type in the account information wrong, and the money goes to the wrong person, then that is your fault. I mean, there will still be a way to retrieve the money, because most likely you've sent it to an account that doesn't exist and it's going to bounce back. But if you're unlucky and you actually hit an account that does exist, then, the bank could generally say, well, I'm sorry, but you put in the wrong number, what do you want us to do? Yeah. Or if the bank's not going to be able to help you. In exactly the same way that if you call the bank about an unauthorized transaction, will say, if this is somebody you've done business before, you need to contact them first before you raise an issue with us. So if somebody that you don't know, that you've never done business with you before, puts a charge in your account, then they will assume fraud and block. They will not complete the transaction. The money stays for you. But if it's somebody, you have given them your credit card or your debit card details because you've done business in the past, or you have a direct debit that is not the direct debit by mistake, then it's for you to sort it out with them. So it happens with me all the time. All direct debits that you go to, but you've stopped, and they charge by mistake like for another year, even though you told them not to. Then you have to convince them to send it back. When I'm at the bank, so I'm going to tell you. Or if you make a mistake in order someplace, but you were the one transacting, right? Again, you have to deal with that. But you have to be careful with your instructions. If your instructions are unclear or your instructions are a mistake, or your instructions should facilitate fraud, then you are in violation of your duty towards the bank, and the consequence is that you might suffer the loss that is associated. Now, so that's the key duty to exercise reasonable care and skill in executing orders. You have another duty to notify the bank of a forged payment as soon as you become aware of it, right? Now, this is more significant now because now we have better access to our banking stuff, because before online banking and the online and so on, if you were receiving your statements quarterly, you would probably find out months afterwards if something went wrong in your account. But now you have better means of figuring this out. I'm not saying that this is overtly restrictive on the customer. You just need to you need to act once you figure something out. It could be that you figure something out later on because you kind of check your online banking once a month or something at the end of the month. But as soon as you find out, you need to tell them. You cannot figure out that somebody has charged you something, then not say anything for 6 months, and then call the bank and say, oh, you know, that transaction actually now I don't remember having spent £600 at, you know, Covent Garden sex shop. So you need to tell them. The bank is not going to be that difficult, but technically this is still an obligation of yours that you need to fulfill. So basically that's what you need to do, right? Your duty is to take care with your transactions, and the duty is to notify the bank once you notice something going wrong. So you're more limited. The obligations, or you are certainly more limited than the obligations that are the other way around. And they're talking about protections on the retail setting, right? The customers, and that's where the protections are so tight. Now, perhaps the last thing to think about. What do we mean by fairness in banking contracts? You have the general provisions in the law that are all about making sure that the person knows what type of deal they're getting in. So you have things that are coming from the Unfair Contract Terms Act and the Unfair Terms and Consumer Contracts Regulations. Now, the Unfair Contract Terms Act from 1977 is still in force. The regulations are not, because the regulations have become part of the Insurance Act of 2016. But the Information and Consumer Rights Act is the same as was the regulation. So if you're looking at your post and it talks about the regulations, it's the same stuff. Now, there are certain obligations there that primarily have to do with the expectations of the customer. So fairness in banking contracts is that you're provided with accurate information at the beginning, and there are certain things that the bank is not allowed to do. Key thing is exclusions. So when it comes to exclusions of liability for certain things happening, these are rather tightly controlled. These are not just for banking contracts, these apply generally for all contracts. You cannot put a clause in your contract that says, I reserve myself the discretion as a supplier to provide the service or not. Okay? You cannot say, I refuse to compensate for loss arising out of these things indiscriminately. So there are opportunities that a bank or any sort of liability contract could limit their liability to provide losses. The extent to which this liability is limited will reflect on the nature and price of the product. Things that offer more full protection might have more expenses on the fees that we get, all sorts of things. But the way in which the extent of limitation, the extent of variation for what the client is expecting, this is controlled through these things. So you can have a look at the Consumer Rights Act, and you can have a look at the Unfair Contract Terms Act, and that will give you that information. In addition, now you've got obligations on clear and understandable language. And this was something that was both present in the consumer regulation before, but now it's expressed in various areas, especially for financial services. So my complaint against my travel is going to be that they sold me something that included protection for cancellation, right? And their terms and conditions are not clear because it says compensation for cancellation. A, B, curtailment, subject to the conditions. So the way the various conditions go to the curtailment, not cancellation. And when they sold the product, they said you protect cancellation up to £5,000, no other things. But when you go to claim, they say, I'm with the law. Cancellation is uncovered reasons and death and stuff like that. It's like, that's not what it says. So there's an issue, there's a structure, it's not an issue with limitations of liability, there's an issue with the structure of the contract and complying with the requirements to clear understandable language. Yeah. So all of that stuff is informative of what suggests fairness, and this is a kind of post-contract control if you want. Because, as we said, banking services are regulated at the point of entry, both in the sense of they provide a certain type of products. The terms and conditions themselves, if they're not compliant, then after you got trouble, after you get the contract, you use all those tools in the law to try and get away from it. What happens is, if the bank is trying to rely on a clause in the contract to deny something, and you successfully argue that that clause is ineffective, then the rest of the contract survives, but the bank can no longer link on that clause to prevent you from getting what you want. Here. So basically what I'm going to try to do with the choose is to say your limitations are from curtailment, not for cancellation. Therefore, you cannot rely on these terms in order to deny me the full extent of my claim. They can say, no, I'm going to take it to the ombudsman. They're going to think that the cost of it is too much. They can pay it. We're going to talk about payment systems. This is how you're going to pay for your Black Friday stuff. Now, there is so much discussion about checks because obviously checks were the way to make payments before other types of plastic money and all of these things, and before obviously electronic type transfers. So a lot of the case law and a lot of the legal explanation as to remote payments is based on checks. Now, as to the use of the checks themselves, these had reduced in the UK up till the point that they wanted to stop them. And they issued an announcement that said, because there was a drop in the usage of checks every year and it was going towards zero. So they thought about it and they said in the mid 2010s, that decade, they said, okay, we're going to stop checks altogether. There's no point. And then the use stayed stable. So it stopped dropping. So it seems that there's a core of activity that is done by check that remains static. So the big usage fell off, but then there's a base usage left. So then they decided to keep them. So now they said it's going to stay on. They were about to phase them out, but they're continuing them. And now the bank, if you open a current account, will ask you if you want a checkbook. And you might need a checkbook for what? What's the only thing you need a check for now, really? DVLA. Yeah, they only take payment by check. Okay, good thing they don't take it like gold coins. Yes, if what you want to do is through a paper application, you cannot put the credit card. You cannot pay by credit card. You can only pay by check. So that, and if you're a charity user. So in certain countries, not everywhere, not here, but in certain countries, a bounced check is a criminal offense. And that scares people. So that's why a supplier that is holding a check, they think that they've got more leverage on the customer, because if the customer does not pay, they go file suit. I used to do this when I was doing my training in Athens. I used to go to the court and sue people for bounced checks. They've left the checks. So then you run to the court and you sue them, and then they have to deal with it as a criminal issue. And as we said, nobody enjoys being chased after by the police. Yeah. Now, we understand checks effectively as bills of exchange. Now, what is this idea of a bill of exchange? Bills of exchange comes from, it was the way to make payments over time and to allow different means for these payments other than cash, right? At the time that most of the transaction was done with cash. So you've got the Bills of Exchange Act of 1882. It defines this as an unconditional order in writing addressed by one person to another, signed by the person giving it, requiring the person to whom it is addressed to pay on demand or at a fixed or determinable future a certain sum of money to the order of the bearer. So if you hold this, and it's between bills of exchange and checks, that the checks need to be made to a particular individual, okay? At least now, the fact that the checks are now crossed means that they are only for the payee. So it is only the name here that can cash in that check. And also, UK banks will not give cash. You can only pay in checks into account. So if you're not the account holder, you cannot cash in a check. So you need to go to your bank, give the check, and they will put the money in your account. They will not give you cash, even if you're a customer in the bank, right? They will not give it to you in cash, and they will not exchange a check for somebody who is not a customer, absolutely not. And this is a recent change, and this has caused some issues for tradespeople, that somebody would go and cash in quite a lot of checks, but now they refuse to take them. They need to be in your name and in a specific account. You cannot do it on behalf of others. Yeah, and it's a security issue because there's a lot of stuff that can happen if you're exchanging these things for cash. However, bills of exchange could be the document on its own upon presentation. So it is the bearer of the document that has the right to exchange it for the stated value. And also it can be transferred, because it's not on a named person, it can be transferred from one person to the other. In other jurisdictions, when you can endorse checks, you could write somebody else's name at the back and give it to them. So when I was working in my grandfather's shop, we had a lot of checks that were like completely random people, yeah? And it was right at the back, you had all sorts of names, because one person would pass the check on to the other. So initially it was in my name, but then I would give it to you. I would write at the back, I'm passing this to that person, and then you would write, I'm passing it to that person, and one person would pass it to the other. So this is, of course, a risky business, because you're passing on a liability that belongs to some kind of ultimate person that if you don't know them, you don't know whether they're credit worthy or not. But for a regular, between people who were trading with each other regularly, this wasn't a problem. They say, I got a check from the guy, is it okay for you? They were just passing the checks instead of cash, the various tradespeople. It was just to avoid having to go to the bank to queue to get like a significant amount in cash and then to bring it over and put it in the till. There were also security issues with that, not having a lot of cash flying around. And back in the day, cash was also kind of bulky. Yeah, my grandfather had a safe that was big like this, and it was stuffed with cash. Because the value of the currency was rather low, so they ran in the thousands. So when they had to make big payments, my grandfather was feeling it, blah, 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 and he could count them in his fingers. Now we cannot count. We touch a tenner and we cannot even hold it. Okay? But back in the day, they were used to this. So you would take like a wad of cash like this and go. I thought that was fascinating. Yeah. So equal to the idea of bearer bonds. You can have a bond that is for a particular individual, meaning that you can cash it in for the value, or you can transfer it if it's a transferable bond. But you also have the idea of bearer bonds. So if you find it somewhere, you can go and cash it in. Which is also when you buy some old house and you take down the wallpaper and you find that at the back of the wallpaper they've got old share certificates or bearer bonds, and then you can run to the bank if the bank still exists. That's why. If you're taking down a wall and you find anything by Goldman Sachs, call me. So there we go. Now, so we've seen what a bill of exchange. Now, the technical meaning of a check is also defined in the Bills of Exchange Act of 1882. A check is a bill of exchange drawn on a banker payable on demand. And then you got the variety and of the checks on a bank account. We already talked about the endorsement. Now, what is the clearing process? Now, here we got a bit of an issue. The money needs to make it through from one person to the other. If I'm paying you cash, you get it, then that's it, end of story. There's no intermediary. There's no chance of hiccups in the process because there is no process. I count the cash in front of you, you count it yourself, they're correct, we take it, that's that. However, the whole idea about bills of exchange and checks is the fact that there's a remote process. What happens if the bank doesn't send, the other bank doesn't send the money? So you deposit your check in one bank, the bank will contact the bank or the other version. If they've got enough money in the account, this is the customer's mandate, we were discussing last week. The bank is obligated to send the money already. So for you to be able to take that money, the bank needs to take the money out of the account of the person who wrote the check, send it over to your bank, and then they need to deposit it into your account. So the remoteness of the transaction means that there's time involved and there is some opportunity for error. So you need systems that both facilitate the transaction, create the avenues of communication between the banks, but also systems that can make this more fluid and more predictable. And what you have now is with checks, perhaps there aren't that many intermediaries, but things have become a lot more complicated when you're looking at transactions with cards. So there are many different types of cards. And you perhaps, I don't know, maybe you got more payment systems than you used to have in the past, that you've also got less in a way. What is the logic of a card? A card allows you from your bank and your bank account to the store with which you're trying to make a transaction. So instead of writing a check, the initial creation of this was, instead of writing a check and giving it at the shop, you can give something that is recognized and understood by the shop that will have the same function as giving them a check. Initially, the process of paying on a credit card was similar with the checks. You guys are too young. Did you ever do a card transaction on a paper form? At the end of the month, know whether it was, or like every few days somebody would take all these slips of paper to the bank, and then the bank would check that this is appropriate and go through the same process as you would have with the check. The arrival of electronic communication systems allows this to happen faster, but you've got different types of cards and different functions within those cards. The key difference is between a debit card that links to an account and operates directly out of the balance of that account, meaning that if you got money, it'll pay. If you don't have money, it will automatically reject at that point. And a credit card, which has a preset balance, you can enter into transactions, and then you settle this by invoice, depending on how you do it. Most of us have a monthly connection between some account and our credit card account, or tell the account that the money goes. So, usually the credit cards either they will bill you every month, so they spread out the payments, and then you have to pay some interest on that, or you can settle your entire balance at the end of the month without any interest. But the thing is, this is to facilitate you to it's the availability of credit that you give with a credit card, and the ability to pay in the future, which is a service provided to you by the bank, not the shop. Because the shop could also give you the opportunity to pay with installments, which you could do with whatever forms of payment you have. You could go there and give them cash every month. But the facility, the credit facility offered by the bank is between the bank and you, is not done by the shop. The shop gets its money, try over. Now, how do you deal with the flow of information and the flow of money from one to the other? And this is where things now are getting a little bit more complicated. You need a facilitator, because the bank, your individual bank, does not have the system that communicates with the shops. The bank will will offer you an account, will offer you a card that goes with this account. Perhaps the bank will offer an equal account and the machine to actually do the transactions to the shop, but each individual bank cannot have its own system of communication. This used to happen in the past when you had very few banks that did this type of transaction, and everybody had American Express and so on, because it was the bank that provided you with a card, provided the account to the shop, provided the machine to the shop, and dealt with the whole transaction from one end to the other. But now you've got too many banks in too many places, so you need a facilitating infrastructure. The facilitating infrastructure is offered by MasterCard or Visa or American Express. There aren't that many, right? Yeah. So you've got Amex, you've got Visa, you've got MasterCard. But the ones that now we're familiar with in our everyday activity are those. So what do these guys do? These guys, each with the banks, provide the communication system. So you are the customer, you got your bank card from your bank that is participant in this network. The merchant got their bank account and their payment facilities from their own bank that is also participant in this network. And because everybody participates in this network, the transaction can communicate the information and the money can pass from one to the other. However, you now have a problem because you've got a series of people in between. You remember for the checks, the banks were communicating with each other. So to build a system that says you deal with checks in that fashion, which deals with issues of delay, the card's concerns about insolvency, one of the parties, but then you only had the customers and the two banks involved in the business. Now you got plenty. You got the customer, you got the store, you got two different banks, and you got the facilitator in the middle. What happens if solvency event or a liquidity problem within this chain? The thing is, the system cannot operate if there is a risk of disruption. What you need with cards that you did not have with checks is the immediacy of the settlement. So systems have been created that allow the instantaneous transaction, and somebody needs to bear the risk of that transaction not completing. That risk cannot be at the end. It cannot be the customer or the store that bears the risk of a breakdown in the chain. So the risk is held by the facilitator. Okay? And that's why, so in situations where you have a central clearinghouse that assumes the risk of failure at some of the component parts of the system, and that's why there's a cost in using these services. Okay? Stock markets. Yeah. The stock markets. Yeah. But this is an important function, and also it allows for the development of communications and electronic systems, allows for the instantaneous connection. And also the systems that buy something now that I was in Athens, I went to the supermarket, right? I put a basket full of stuff. I put the cards, put the PIN number wrong. Bollocks. I must have punched it wrong. I put the PIN number again, wrong again. I was thinking, shit. Then I realized I changed card. That's why I had the new PIN number. I'm thinking, okay, I'm not gonna do this the third time because if I get it wrong again, I'm screwed. So I pay with cash, I have just enough. Yeah, otherwise I will start throwing stuff out of the basket. I go then to another shop, I'm thinking, okay, let's try the card because now it's a different machine. I'm gonna get another 3 attempts, I'm gonna figure it out. I'm gonna get another 3 attempts, I'm gonna figure it out. Put the card in, it says, you're on your last attempt for your PIN number. So you see how responsive the systems are. Not only it communicates in real time with the bank, because this was a debit card, so it communicates in real time with the bank to authorize the balance, but it also commits security functions that are involved with the PIN numbers and things like this. So luckily, I got it right, so now I've got another 3 attempts to get it wrong. Well, I mean, if you're talking about compatibility of systems, then yes. I mean, they're all made to work together.
Yeah.
But the thing is that this is too big a task and too spread products, providers, jurisdictions, so it needed a central facilitator that is independent of all of this. So that's why you got Mastercard and Visa as the predominant standards that provide the service. But of course, there's a cost to the service.
Yeah.
And what I was trying to demonstrate is that the cost is not only the cost of maintaining the infrastructure, it's that the cost is not only the cost of maintaining the infrastructure, it's also risk. The risk of failures in certain parts of the system, and a risk that the bank has communicated the money, to the shop, and then they realize that you didn't have the money in your account, or there's some failure or some cost. You know, you have your credit card, right? Your credit card has a certain limit. You need to settle that balance. If you don't settle that balance, you owe money to the bank might suffer a loss. This is usually the reason why there's a fee in using the credit card, both in either in terms of an annual fee or in terms of the interest that they charge if you select to pay with installments, because that is a reflection of the risk of default. But the improvement in the systems means that these now operate, electronic transactions operate in an instantaneous fashion. It is being improved at the request of the regulator. Because one thing is the technology, and the other thing is the desire of the bank. What happens if the transaction is not instantaneous? What happens is the bank holds your money. Okay? And while the bank holds your money, you can do stuff with your money. This money doesn't just kind of sit there, it is an available balance. So when the bank takes 5 days to cash in a check, it doesn't mean that bank A is waiting for bank B for 5 days to send the check, but he got the money, it's just sitting on it. Yeah. So with electronic transactions, if there were a few days to clear, the bank would be holding on to that money. So effectively, it provides liquidity to a bank as the bank delays the transaction. Once the technology allowed the instantaneous transfer, then the regulator obliges the banks to improve the speed of payments. And that's why up till a couple of years ago, when you were sending payments through your online banking, they would appear next working day or a couple of days after. Now they appear immediately. But what I'm trying to demonstrate is that this is both an issue of infrastructure and technological capability, but it's also a matter of regulatory demand. Because the banks would be perfectly happy to hold on to your money for 2 days. Actually, I'm quite shocked that I'm sending money from one account to the other. I log in, send it, log into the other one, like 5 seconds after, and the money is already there. But yes, on online banking, it happens immediately. But be aware of one thing, though. The speed of the transaction doesn't mean that there are no additional checks, or that the transaction is irreversible. The transaction is always reversible if an error is discovered in the system. Of course, you could always go and withdraw the money cash. It doesn't mean that if the transaction is reversed, they're going to ask for it back. Imagine you've got £7 in your account. You check your online banking, it's £7,000. You have to, actually no, 7,000, you will be able to withdraw it in your bank. It is you run to the ATM and withdraw it. So now you've got £70 in the pocket that you can spend. If the transaction is cancelled because somebody sent you money in there or they ask for it back, the bank is going to ask for it back, but in the meantime you got the money you want. If the bank invested the transaction, then it will disappear from your account. So again, it's a play between available balance and liquidity and time and all of that stuff. You need to be careful when you banks to be checking on your online banking the available balance. Because headline balance is when kind of big mistakes throw. Headline balance is the money that you should have in your account. Headline balance will not include transactions that you made 5 seconds ago in a shop, even though you go to PC World, you walk out with a new PlayStation, and it will not yet show on your bank account, even though they've been paid. This ensures they've been paid, but it doesn't show on the headline figure. It will show on your available balance, because pending transactions will be removed from your available balance. Also, a check paid will appear immediately on your headline figure, but it will not feature the available balance until the check has cleared. So what you're always interested in is what it says as available balance. It might include any overdraft that you have agreed with the bank. But you need to be careful with this, not to be caught out. Because I've been caught out by this a couple of times. So I make a payment, and I was thinking that I just looked at what it said at the top. Okay. I make a payment for £500. I get a text message from the bank within 5 minutes, says you're £480 withdrawn. And it says if you don't bring it to zero at the end of the day, then there's a charge for you using an overdraft. Because it just said 500, it said 500, it said like more than that. It's like, what the hell happened? What happened is that I was looking at the headline figure, not the available balance. So the available balance was very little, right? Because it was a check waiting. So you need to think about the security, the speed of the transactions, the security of outcome for the shop and the customer, but also how the various bits within the system deal with it. What this means for you as your available money, this means for you as your available money, non-available money, about the reversibility of certain transactions, but also what it means about risks of default within the system and where something happens. Also, for those of you interested in data security and kind of IT issues, there are concerns here now with the stability in terms of IT security, because if there's a failure here, then the whole thing falls apart. And you have it often, right? That lately you've had, yes, a bank having problems, so anybody who holds machines or cards associated with this particular bank, they're having the transactions declined because this does not respond in the system. Or even worse, you can have a failure here. If you have a failure here, it would be a worldwide stopover for that particular facilitator. But of course, the facilitators are more robust than the actual banks, but these are complex processes with many bits and bobs, and as it goes with complex processes, they tend to fail, and the higher the usage and the higher the complexity, you have issues. I mean, I was discussing with some gentleman who works for this. He actually works for the IT systems that support these, that facilitate those transactions, and he told me it's a horrid, you know what, it is always going to be a horrid mess, because you have the incorporation of new technologies and new systems upon older ones. So this is ongoing. So you cannot have a state-of-the-art system that covers the entire chain. somebody's working on older stuff, somebody's working with newer stuff because the newer stuff is coming in stuff, somebody's working with newer stuff because the newer stuff is coming incrementally. So the system is always inherently unstable because it incorporates these different things that are not necessarily very compatible with each other. The thing is, and the job of the regulator in involvement in this is to making sure that overall the system can withstand stress and doesn't totally fail. So you will have the occasional bank that from one time to the next is not going to work properly. Advice to retail customers is to have accounts with more than one bank, so you've got like an alternate card that you can use if in need, okay, or to carry some cash around. It's less fun when you get mugged. The job of everybody is to ensure that any failures are not long lasting. So a bank can suffer a failure for a day or two, or their own online banking not working. It's unpleasant. The bank might be obligated to compensate people who suffer losses, because if they cannot fulfill the customer's mandate due to an IT problem, that's their problem. Yeah. So people who could not make transactions, lost deposit for houses, lost payments, they had to suffer charges and penalties for missed payments, they get compensated by the bank. But a systemic failure across the system, which means that the facilitator has gone down, this is more severe. And that's why it doesn't really happen. Now, and that's why it doesn't really happen. Now, and also the expression of these in the law is that you got stuff like the settlement finality directive, which deals exactly with these mechanisms. So the mechanisms of ensuring that the end of the chain is protected in the final thing that we can talk about. And now we've got other types of payment facilitators as well, things like Apple Pay, Google Pay, and there are all these things, PayPal, and now these offer similar services with your traditional bank services, but they don't operate on the basis of a card in the traditional sense. Right? But now again, you could argue that it's the same as the card, because the technology now turns your electronic device into a bank card by having the ability to communicate. It's just that your facilitator in that case is not Visa or MasterCard, but it's Apple. So this is, again, the infrastructure. So where you had MasterCard at the top of the building before, now you've got Apple Pay or PayPal. The process is the same, and the regulation and function not be the same. In a way, I've been told that using your, if you got the NFC on your phone, so you can use your phone for contactless transactions, it's actually more secure than using the bank card, because there is a representation of your card on the phone, meaning that cannot be replicated. So if I steal the information from your card, I can make a dummy card with this information, but I cannot make a dummy card out of the token. Consumption is a regressive tax, because, and it's called like that because it hits everybody indiscriminately of their ability to pay. So if you're a rich person or if you're a poor person, VAT doesn't care. VAT is going to be the same level all the time. So obviously, if I'm a rich person, I don't care that my pasta costs £1 or 80p. But if I'm a poor person, the 20p that is the difference between one and the other, progressive theoretically, the more income you have, the more you pay in tax. Now, apart from the fact that if you make a lot of income, then you've also got very clever accountants that can present it like you don't have any. That's how big corporations and big high street names and ranging from Amazon to Starbucks and so on, there's always complaints that their tax exposure is very limited because their income tax bills are very low. And you're thinking, how the hell these turnovers and their income tax is very little? How come, seemingly very, very rich people end up paying very little tax when, anybody who just pay on payee, there's like huge chunks taken out of their paycheck every month. But anyway, that's a discussion for a different day. The importance is that income tax will take more money out of you the more wealthy you are. VAT will not. Would it be an alternative or a component of a tax system to impose a tax on the transactions themselves, meaning that the people who move more money pay more in tax because there is a small chunk taken out of about every movement of money that represents this tax. So we're not talking about tremendous amounts. I mean, the financial transaction tax maybe like a file. I don't think it could work instead of all the other taxes. It could be in addition to all the other taxes. So it kind of perhaps reduces some of the taxation burden someplace else, so they can use that money in order to give it back to somebody else or to spend it on something wonderful like Brexit. So a financial transaction tax will hit the people who move more money, because if I'm moving £1, I pay. So if I'm moving £1, then I pay 1p, okay, it's not a lot of money. But if I'm moving like £1 million and I pay 1p for like £1 in that million, then there's a lot of payments there. Yeah. So obviously, the higher the volume of the transaction, and the higher the frequency of the transaction, the higher the burden of this. There's a big debate as to whether this is something that we should do or not. Obviously, the industry does not like it. The financial industry is not in favor. It might require countermeasures, meaning that you need to reduce availability of cash, because if you impose financial transaction tax at high levels, we might start having people moving suitcases around. Because I might be thinking, if I give you my money in a suitcase, if I give you £1 million in a suitcase, I save myself like £100 in that tax instead of sending it via the bank. So it might engender a return into the cash economy, which you do not want, because cash is difficult to control. It facilitates criminality, money laundering, but cash now is very difficult to control. But anyway, this is something to debate. Other people are saying that this is progressive, so some countries, I mean, this now chart is perhaps a year old, but some countries are in favor of it, some countries are not. Each one of these things that sounds probably going to happen. So I think the impact of this is going to be severe for the banks and the industry, but on a personal level is going to be quite small. So if the government came around and said, we drop the VAT 1%, don't be old. You know what? If I told you that, if I said you give me £100 in cash, or you send me £100, I will receive in my account 99.9. Some of these terms might be familiar. So what we're gonna do today is try and go through them a little bit, so you guys understand what is the background of the financing techniques that we find in the banking sector, but in the corporate sector a little bit more general, and that it helps you understand some stuff about how banks do business with each other. Because if we're looking at the domain of international banking law and regulation, we spent the time up till the reading week talking about the regulatory structures, right? And now we're looking into the sort of more everyday activity of those institutions. So we spent the last couple of weeks talking about how they deal with the retail customers, right? And what does it mean to have a retail exposure for the bank, and then the types of things that they can do, and the types of the payment systems that they have, and how these operate, and what are the consequences, and how it becomes interlinked. But I think it would be a partial understanding of the business of banking if we did not discuss what happens at this level, at the business-to-business level, or bank-to-bank interactions, or market interactions. And this, of course, is not the retail, right? But what the banks do to a large degree is not the retail. And a good proportion of the banking system, especially here in the city of London, is wholesale banking, as it's called. This is not retail banking. And London has become so famous and has become so rich and so successful for growth precisely because of these things. So we're going to go through some of the notions. So when you see them in the literature, it doesn't seem completely surprising. So some of that stuff we've seen before to a degree. How would a corporate entity raise money? First of all, they want to raise money because raising money is an easier way to do stuff. Yeah, I wanted to buy myself, I want to go to a summer camp, right? And the summer camp costs, say, £600. You go for, say, £600. You go for a week.
and I don't have 600 pounds. So what can happen is that I save every month, then I've got that I can go away for my summer camp. I mean, if they do the working up, which was the last one on this trade of the interesting. I want to get it for Black Friday because they've got don't I book it now, but I have to pay for it now. I save myself £100. So why not? Okay? But in order to do it now, I need to have the cash now. If I don't have the cash now, what happens? So I need to get the cash now. In a retail setting, that would mean that I use a credit card. I have something that gives me the opportunity to spread out those payments, but it makes the money available for me to do something whatever I want. So imagine this talk on a much bigger scale. If we're talking about a business that is finance in order to be able to invest in production, expand, if they want to raise the finance to pay some vacant debt we have due, but I made the issue. And it's an essential, it's not like everybody wants to accelerate what they're doing, they cannot be bothered to waste or accumulate profits. The availability of finance and the availability of credit, as we so commonly do, is an essential component of a proper function economy. So you raise the money, one of the ways you could raise the money is by offering securities in two varieties. One is equities, meaning shares, and the other one is debt securities. So you raise your money from the public. If you're a public company listed in the stock market somewhere, you could make shares available for sale to the public. This happens on an initial level. This you will see in the press, it says that they're floating, the company is floating in the stock market. What does that mean? It means that they make their initial sale of shares to the public, and the money that people get at that point comes to the company. So if you make 10,000 shares available at $100 each, everybody who buys a share gives you $100, you take those, you put them in the bank. And now, of course, you have sold a piece of the business, because the business will probably happen to those pieces, and all these people now have become owners of your business, and this has significant consequences. But in operational terms, you have now gathered an amount of money that you can do something with. You could alternatively, instead of you could issue debt securities, meaning that you can offer a bond. This is not, this does not give people ownership of the business. This is just a claim in debt, meaning that you can go and you can buy a bond from General Motors, or Nissan, or General Electric, or BT, or whoever else that they sort of thing, right? And this is just a piece of what? It's not a piece of paper anymore, but it's a contract that says, I get £1,000 from you now, thank you very much, and £1,000 with say 10%, right? So you give me 1,000 now, you come back in a year's time when this bond matures, they give you 1,000 now. Why does the company do this? Because the company now has the capacity to get quickly the cash that it wins and do something with, and it hopes that its profitability and its finances are going to be adequate for the company to be able to compensate, to give you back that amount plus the interest that you're free to get at the end of your period without use at all. And that, so basically what they're thinking is, when they're pricing a debt instrument, they're probably thinking, I get a lot of money now, I invested in a way that increases my profitability, increases the size of my business, therefore, by using that money for 12 months, I could have actually generated enough profits, both to pay these people the interest that I promised them, and to have something. The calculation is one that ends up with the business in a better place in a year's time than this. Now, of course, this is involved, we're going to talk about how to protect against those risks next week. The risk with purchasing shares to corporate, if you're purchasing at an initial level, so the risk is that it's the overvalue, the value you try to tell it, so there is the world where buy them without price and use some money. If you buy them in the secondary market from other people that are passing their money the other again, we need to make calculation, is this share like to go up or down, it is if it goes down and gets money, if the company will be involved in the stock, you get that. So if your company goes insolvent, the shareholders are gone. Because the whole idea of insolvency is that the company actually has obligations that it cannot meet. So after everybody hasn't paid out whatever assets are left, there is an ending there for the shareholders. Well, yeah, I mean, it depends on the country, the language kind of differs, but if you have an ownership stake in the company, if you have equity securities, you do not have an ownership stake here. So here you have a simple debt-creditor relationship. So here, in a way, it's like a bank makes a loan to the business. How, within all of this, we can think about corporate finance as a concept. Corporate finance is this idea of coming together with a plan as to how to fund the business. Now, why is this an academic subject and why is it discussed? Because it is a complex arrangement. It is a puzzle of components that come in securing appropriate financing for a business, and it is a very difficult process in determining should a company be raising money through accumulating profits, what mean for its investment plans, should it raise money through the public in the form of shares, should it raise it through loans, should it raise it through debt securities, if it's using all of these mechanisms, at which proportions, what is the cost of the various selections, what is the risk attached to the various selections, right? So these end up in complex business plans, and the financing bit of the business plan is a very significant endeavor, which kind of lends itself as an academic subject, because there are all these things that you need to think about, and then you need expertise and a structured way to approach the whole thing. That's why people end up doing stuff like corporate finance. Yeah. So if you do this, you will begin to understand these things in a little bit more detail, and the classes, and I mean, this has emerged as an independent discipline already, like the 1950s. Yeah. People became aware also that this is a significant service to offer. So if you're the firm that advises the people how to put together their financing, they will pay you very well for it, because it is a business that is highly complex and requires expert knowledge, right? Therefore, it's worth something. So who is involved in this business of corporate finance? You got both public and private companies, and everybody within the management chain of that, but specifically people that have to do with accounting and budgets and things. The governments themselves, it is a very significant component of the work of the Treasury, for instance, thinking about funding, taking care of the funding for the government, and the variety of tools that a government can raise money in order for the state to be able to pay for what to do. And the advisors are normally resting in investment banks or accountancy firms. So this is the outside help that either the private or the public sector will seek in order to put these complex plans together. This is how all these things comes together. All of these are components of what you will have if you're engaged in the business of corporate finance. Some stuff you cannot do, right? So let's not kid ourselves. You guys are going to be on the law side of it. You're not going to be on the accounting side of it unless you've also got an accounting degree, because we cannot do the valuations, right? I mean, we can barely understand when the accountants are talking about what they've done after they've done it, never mind actually doing it. It's like I can cook you a lasagna, but I cannot cook you like an elaborate patisserie, and I cannot make a milfei, but I can make lasagna, right? It ain't the same thing. Or I can look at the milfei and say if it's nice or not, but I cannot actually make it. To be fair though, I haven't tried. Yeah. So they will do the valuation, the capital structuring, and so on. Some of it is numbers, which you cannot do. Some of it is the legal expression of those numbers, which you can do. But also what you've got is business in mergers and acquisitions, or issuing new equities. All the regulatory bits you can do. So you will get Goldman Sachs to give you the numbers, right, as to how they should price a new stock that is launching in the stock market. But you, the lawyers, are going to be the ones to put together the prospectus, because you're responsible for compliance.
And these are the stuff that we've seen already. So you need the lawyer. So the financial advisor gives you the numbers that you should put in there, but the lawyer will structure the narrative around. Again, this is something that gets paid loads, because as the regulatory burden and the regulatory requirement increases, the bigger the prospectus gets, any issue of shares or of bonds or of anything comes with a lot of regulatory detail in order to be compliant and to make it into the market that it's trying to go. All of this is done by the lawyers. This is going to be very expensive. So the big law firms do a lot of this. We were talking about the risks before and how the risk features grandly in discussions and debates about pricing and how you put together the legal stuff and how you want to position yourself. And what we were talking about before is the distinction basically between the business and your financial risk. Your business risk is that you're selling stuff that people don't want to buy. Or you're selling stuff you cannot match prices of other people. Why does everybody in the high street shut down? Because they cannot compete with the online providers. Okay, shops down there cannot compete with Amazon, because everybody buys stuff at pretty much the same prices and they import them. A small shop cannot import in the same bulk, so they have to pay a higher price. Then a small shop has people in there, has got front-facing retail that's more expensive to maintain, and rely on footfall that is not steady because now everybody does them online. So you cannot compete. That's your business risk. But your finance risk is the stuff that I was explaining before. How do you raise the money to rent the shop? How do you raise the money in order to buy the books initially? Yeah. How do you raise the money to pay your employees if you've got employees, or pay any other obligations? And then what is the burden of servicing that debt? And what impact does it make in your profits? And if you don't get this correctly, the finance risk will probably sink you before the business risk comes in. And there is something, because you guys are lawyers or in a law school, in any event, there are also issues about legal risk. The legal risk is the expression of all these things in the documentation, because sometimes the intention is to achieve something, but the way that it has been expressed in the legal language is not appropriate, and you end up with unintended consequences, or something goes wrong and then you find that there are gaps in that then cause you trouble. So there's always an element of risk that is legal, and is also the cost of getting the appropriate legal advice to express all these things in the way that they need to be. Now, there are other types of risks there that have to do with other things, and strategic risks have to do more with the state of the overall economy. Because if the economy is suffering stress, it could be that your business idea is nice, it could be that your debt servicing is contained, it could be that your legal documentation is fine, but if you're going through a period that everybody's freaked out about losing their jobs and they cut on their discretionary spending, then maybe they're not going to come, or all the Europeans are thinking they're going to get deported in March, maybe they're not going to buy too many books to put on the shelves. So these are other kind of outside environment risks that affect your business. You need to be sure about terms that you're using and to use them properly, because one of the most annoying things is when you write stuff in your essays that you don't quite understand, or you take them to mean something else, and this gives the impression that you're not on top of the material, therefore you get lower marks as a result. Yeah. Now, you will come across a variety of those terms in the literature. You don't need a glossary in your essays. You might need a glossary in your dissertation if you deal in familiar concepts. Like a glossary is a list of defining key terms. Yeah? Define some of the key terms. Avoid abbreviations if you can help it. It really annoys me that people will offer their own abbreviations at random, so then they produce this kind of incomprehensible document with full of kind of letter combinations. Bank of England, you can put BOE, well, I'll understand that, but if instead of the British Prime Minister you write BPM, right? So don't randomly abbreviate stuff. Only use abbreviations that are common in the literature that you're using. Otherwise, it's not like you're writing it by hand. You don't need to save the space. Use proper words. Now, everybody understands what FDI is. We're talking about foreign direct investment in a lot of contexts. Now, concessional loans are things that are more specific to government loans. So this is how in project finance you put together the financing for significant infrastructure development projects, right? So if you come across the term of concessional loan, it's usually in relation to this. Somebody gets a concession to run an airport, right? So they deal with a country where they built the airport and then they operate for a certain times of years and the government pays them throughout to do this. And when the concession runs out, then the resource stays with the state. Yeah. Portfolio investments are the things that I described, that is a diversified portfolio where somebody has got a pot of money that they need to invest, and they invest it in a variety of places and they keep track of the performance of the various things at the same time. You've got, in terms of financial structure, you've got a series of things. So debt and debt instruments can express this in a variety of formats. So if you're writing something in those areas, you need to have some appreciation of what this is. I mean, there's a difference between corporate bonds and sovereign bonds. There's a difference between different types of debt issuance and the bonds themselves. So I mean, this is not in the context of this class to go through these in excruciating detail, but you should be using the appropriate term if you're using them in your essay. Now, these are things that we've done before, right? So when we were talking about checks, we started off with the idea of bills of exchange. These things that are written orders that the holder of a document can perform a certain action or has a demand expressed in that document, that then this is fulfilled by the institution where you present that order. You've also got letters of credit that of credit are not the same as checks or bills of exchange, and the letters of credit are not transferable. However, a letter of credit is a commitment that somebody has got your back. So if you need to demonstrate that somebody guarantees something, no, but the bill of exchange is a description, is it like a background legal description for a lot of the things that you do have. So checks, for instance, are still in use. That's what we were talking about the other day. And the legal background is that it is bills of exchange.
Yeah. But it's also gonna norms. You cannot deviate from it and not practice too much, because if yours look very different from the others, maybe people will not want to buy them, or they will ask for more money.
But these are the inner bits of the legal arrangement of these things. Perhaps we can finish off, I guess, with these things. Now, I told you that in insolvency, you have a list of people. So first of all, the first people to get paid if something goes bad are the people who are considered secure creditors. A secure creditor is somebody who is running the process. So of course, the people that you will hire to run your liquidation, right, the accountants that have to to dissolve the company, they have to get paid. They're not doing it for free. So you're going to have to pay them. They're the first ones to get the money, but also people who got fixed charges. What are the fixed charges? People who said in their loan, again, said, if you guys go bust, I come and take a specific resource. Not in general, I'll get a table on you go to deal with this thing. This one is a reserve to my table. So if something goes wrong, I can get this. So these are the people who first come in and collect from what's available. I'm not saying that it's going to be available for everybody, but that's the deal. Secondly, you got preferential creditors, which might be employee wages or pension fund obligations. So after the people with a specific claim over a specific asset, after they've taken it away, you get those that are called the preferentials. Then you got people with a floating charge. What is that? People who said, in a default event, I will come and take from the start that you're funding, here's something that people's your obligation. So they will say, out of removable equipment in the classrooms, I'll take
£500 for it. So it could be that thing, this thing, the other thing. But because it's on specific, it's not this specific labels and from your stock, they are at the lower level of priority from the other guys. Because this is a more flexible sort of financing. If you have fixed charges over everything, then the business cannot need your permission before they change the table and get them out. But if you got a floating charge, then it's up to the business to arrange what sort of tables they've got inside. Then you got anybody who's an unsecured creditor, and that includes the tax. Not in every country, but this country includes the tax. Not national insurance obligations, because national insurance obligations will have employee wages and pension fund obligations. And usually you get the big fights in insolvency, for instance, with whether they should take the national insurance at the top or the bottom. But the unsecured creditor is somebody who's owed money, but has got no additional legal link with the asset of the bond. You order your ski equipment, right, online. And before you go for your ski vacation, the company goes bust. What do you get? Nothing. But unsecured credit. You order your phone from the local phone shop, and the phone has arrived and sitting at the desk, but you don't get in because it went bust this morning and there's nobody there and the door's locked. Can you go get your phone? No. Somebody put your name on it. When you see the desk for you, but it's not your property, because the moment that they've got sold, all the assets will be sold. It's a process, and you are an unsecured creditor, meaning after everybody else gets paid, you then even ask for your money back. Of course, if you're a customer, there are some things to protect you. So your bank, when you bank for your bank cards, if you use the credit card, they might be able to help you with that in a discrete scenario. But then it's you getting compensated from your bank because of the specific arrangement you've got to apply for full operation of law, because it was a credit transaction, or some other type of insurance. The shop was from past, it operates through that process. And in the end, as we said, then you get any interest payable on any debts after the unsecured, and then in the end you got the shareholders. But imagine, if it's a company that's gone bust because it ran out of money, by the time you got down there, you've obviously got nothing. We've gone through those, how a company raises money and the various ways in which it can raise money. I want to focus on, now before we finish, is this idea of insolvency and protection from insolvency, because you've got different ways that you can secure yourself in markets and different ways that you can secure yourself in a commercial environment. In a commercial environment, this is, well, in any environment really, this is the order of, at least in English law, the order that you get your money if somebody goes insolvent. Now, it's what we saw last week as well. You've got your secured, then your preferential creditors, then you've got floating charge holders, then everybody else who's an unsecured, then any interest, and then at the end of the chain, there are the shareholders and there's anything left. Now, by default, if we're talking about a stressed situation, there's nothing left to distribute back to the shareholders. If you are doing business in the commercial field and you're trying to advise a client what is the best position for you to be in, obviously the best position for you to be in is at the top of that chain. There will always be some valuable assets in a company that goes insolvent, right? Most of the time, we're not talking about the situation that you walk into the warehouse and you find kind of mice and spiders. Usually there's something there. The thing is, you want to be the first person in line to get whatever is in there. The number one best thing for you to do would be not to participate in this chain at all. How can you be outside the chain? Well, there are a couple of ways that you could do this. If the things that you're trading with the other party are never the other party's property and they remain your property, then if they go insolvent, these are your things, they're not theirs. So whatever priority list exists
for the satisfaction of creditors in insolvency is not relevant to you. Your things are still yours. This can be achieved through contractual mechanisms, through what are called the retention of title clauses. You put a clause in the contract when you're selling stuff to somebody. This only works for the sale of goods, okay? That says these items remain the property of the seller up till full payment, either of the particular invoice or all invoices that relate to those two parties. So if you've got the regular, if it's a one-off, then it's for this particular invoice. If you've got a continuing relationship that, you know, you send them stuff every month, you can say that so long as all invoices for the month are not clear, then these items do not become the other person's property. You've got this capacity, it is built into the Sale of Goods Act. You can distinguish in English law between possession and ownership. That the goods would be in the other party's possession because they've been delivered in the warehouse, but ownership remains with the seller. There are some criteria, meaning that they need to be kept separate and identifiable from other goods, because obviously if the goods are generic and they've been mixed, then their identity is lost, so your clause is no longer going to be operational. If you're sending something generic like oil or, you know, gas or something like this, and then it's put in communal tanks, then it is lost within the communal tank. But if you're selling goods that are identifiable, they're labeled, and they're kept in their warehouse, they can be retrieved, then it works. There have been some attempts to deal with products that are mixed, or even with money, that the money that if the goods have been sold, the money represent those goods, and would the retention of title clause be still operational on money? This is dodgy, right? It's been attempted over time. It's been attempted over a number of cases. It's only been successful once or twice. I mean, the most famous case about this is the Romalba aluminum case. But there are very strict criteria in keeping the goods separate and identifiable, and if these goods are replaced by money, then to keep that money separate and identifying the goods. This is not easy to do. The safest thing is to have a provision that says the goods remain separate and remain identifiable, they're warehoused separately, and the seller has got rights of access to wherever they are, so they can go retrieve them if the goods are unveiled. Because also the practicalities of this are important. If the company has gone insolvent and they're in a warehouse that's been locked up and you cannot get in, you cannot actually get your goods. So what you want is the ability to retrieve the goods that are subject to retention of title clause and have the right to actually go away and get them. So this is the best protection if you're a seller of goods, that your goods never become part of the insolvency process, because your goods never came to be property of the buyer, but they stayed with you. Another thing that you could do is that you a guarantee, right? You can get the third party to guarantee the outcome. So I do business with you, but you're the guarantor. In case she doesn't pay me, then you do. What is the difference between a guarantee and an indemnity? A guarantee is a secondary obligation, meaning that I ask her for payment, and if she does not make the payment, then I put the right to come and ask you. An indemnity is an independent obligation, meaning that I can go without waiting for the person to default and ask you for payment, and then you sort it out between. And also any set amounts without having to prove what the loss is first. So a guarantee is a kind of backup for the failure of the original creditor, but an indemnity is an independent obligation. Of course, you know, they're legally structured in different ways, and there is sort of paperwork and bureaucracy that you need to fulfill. Now, everything else, guarantee, indemnity, retention of title clauses set you aside from an insolvency process. Either you have direct access to the goods in question, or you have direct access to people outside of the people with the problem. Everything else, there are mechanisms that are mostly property law related reasons like various charges and types of security that will make you part of the insolvency, but you in different positions in the chain. You can go and register in the company's books a floating charge and a fixed charge over assets. But this is not something that you can do simply contractually. This needs to be notified to the authorities that is going, in this case, is Company House, and it needs to be registered as a claim as against the company assets, and this is a publicly available information. A fixed charge means that you've got a claim over a particular asset of the company that is identified, and if the company goes insolvent, then you can go retrieve that asset. But this is limiting for the company because the company is not free to dispose of that asset while it's still in operation. So if you have registered a fixed charge over certain types of assets, the company will need to get your permission before they change them with something else or dispose. So if somebody has a fixed charge over these tables, and here they basically look at new tables to substitute them, they need to ask the permission of the charge holder. But because it's so limiting, you need to it ranks higher because it's a limiting but important restriction and important protection. If you have a floating charge, which means that you've got written in the company's books that you've got a claim against company assets, but these assets are not identified specifically, but they are valuable things in there, movable property up to the value of X, because it's not as specific as the fixed one, there is not a lower level of priority. So the distinction between the fixed and the floating is this. The floating turns you down a couple of steps in the chain. But floating is a lot better for the company because the company just knows that it's got a claim as against the valuable things that it's got, but it's not limited as to their use. So if you had a floating charge of those over, tables in those ropes, you would exchange it with other tables. It doesn't matter. You don't need to ask anybody. It just means that if the place goes bust, somebody comes and gets whatever tables they can find up to the amount of the charge. How would you differentiate between the people that have registered the variety of charges at different points in time? This will depend on what the law provides, but also on the terms and conditions of the actions. So fixed charge ranks higher than floating charge, but if you've got multiple, you could not have multiple fixed charges over the same asset, right? But you could have multiple floating charges. If you've got multiple floating charges, then the first one that registered takes priority over the others. If you want to give preferential access to somebody, but you've already have existing charges that rank in priority, then it creates a conflict. But the normal rule is fixed is paid before floating, and for the floating ones, it's the first one to be registered prevails over the others. So then it creates, if you want, a sub-categorization, a sub-priority list within each of those classes that determines who gets what. This is crucially important because we're talking about a company that has gone bust and it owes more money than it's got available. So if the liabilities exceed the assets. So positioning yourself either outside this or as high in this category as possible is crucial if you seek any, you want to have better chances of recouping any of your losses. Now, obviously, you can do other things to secure yourself that then belong in a different domain. Right? You could buy some sort of insurance product that says if this person defaults or if I don't get my stuff, then somebody else will pay. This could be provided. For instance, when you're booking through a travel agent, the travel agents have got their own body that insures them, meaning that
If your travel agent goes bust, then there is a body responsible for compensating you. This is built into the product. Financial services as well. There's the Financial Services Compensation Scheme, meaning that there's a government-run body that will refund deposits that have been lost out of the institution that has failed up to the level that the state covers, and it's 100,000 euros at the moment, right? For person. So these are ways that you can get your money back, but they are external to the insolvency chain. So if the bank goes bust, if you're an investor, then you are an unsecured creditor. If you've given them a loan, okay, and the loan is not secured against something, you would be an unsecured creditor. But if you're a private depositor, then you're going to get your money back through the Financial Services Compensation Scheme. So obtaining some type of insurance, either a state-provided already set insurance, or a privately organized one for the industry, or you privately buying some insurance, is a way to protect yourself against chances of default. If we're talking about tradable instruments, then the best way to protect yourself from default is to sell it on. So if somebody these chains that you saw in the video that you bought a package of mortgage-backed securities, right? So you have a financial product that contains within it income streams from a whole bunch of mortgages from Westmoreland, and you're thinking that the market's going south and that the package might default, then the best thing to do is to sell it. Yeah, you sell it to somebody else, then you have limited your loss. Obviously, you're not going to sell it at full value, you're going to sell it at a discount, but at least you have estimated and you've contained your loss. If you sell it at, say, 90p to the pound, then you know that you've lost 10p for every pound, but at least you got your 90 secured. Because if the product fails completely, then you get nothing. Another thing that you can do in the financial markets for these types of instruments is to get some sort of insurance. The typical type of insurance is the credit default swap that you heard discussed over there. The credit default swap is a contract with somebody else that says if the referenced asset defaults, then you pay me a pre-agreed amount of money. Now the beautiful thing about the CDS is that you don't even need to hold the asset, meaning that that's the beauty of financial markets. You can buy insurance products on assets you do not own. For instance, I cannot buy travel insurance for you. I cannot buy home insurance or contents insurance. It's not my home. I cannot buy a car insurance for your car. I can only get these types of products to secure things that I'm the owner of. However, in financial markets, I could do a CDS contract that says, that's a complete bet. It says if the Greek bond defaults, then you pay. And if the English bond fails, I pay you. And we don't need to hold any Greek bonds or UK bonds, but we can just have this deal between us. It wouldn't be the same as kind of betting on a horse in like if the horse wins, then the betting shop pays you X amount of money, nobody owns the horse. But it's a silent contract. So, how do you protect yourself from the potential of default? In a commercial scenario, you can use things like guarantees, indemnities, retention of title clauses, and then you can use the various appropriate company law controlled types of security by registering a charge against company assets. In the financial services domain, you can protect yourself either by disposing of the asset, you sell it to somebody else who's probably dimmer than you, or you buy a variety of insurance products, and these insurance products might work
There are different ones, and they might work all the way from the retail level all the way up to complex financial markets things. So we've gone through the way that you can normally raise finance through normal banking, and we've seen the consequences of insolvency, and we've seen various ways that you can either protect yourself and get yourself outside the consequences of such insolvency. But there are a couple additional things that people use to raise money that approximate what I've described about financial markets. For instance, if you are if you're a commercial enterprise and you're dealing in the sale of, well, actually, this works for services as well as it works for goods. The whole point about arranging financial transactions is an interplay between time and money. And we've seen this before. When we were talking last time about this, what liquidity means and what things that actually between money and waste you get it, that's what it works. So your business is here, okay? And you are what you have. You have a bakery, okay? So you make nice brioche and breads and croissants, you're selling us. So you have, these are your products, and these are your customers. So you issue the invoices to these people, they pay you every month. So if this is the first of the month, you produce your bread every day, you sell it to those people, then at the end of the month, on the 30th, these people are gonna pay you back. You send the goods. I'm supposed to get dollar sign, so you send them the goods. These are your breads. They send you the money, and that's how your business, right? Dollar stuff. You could get your money quicker. You might need your money quicker, so you can buy more machines, you can buy more flour, you can buy more things, you can produce more breads faster and sell them to additional people. So what you could do is that you can take those invoices and you can sell them to somebody. So if these invoices have a total value of £100, you could sell them to somebody for £90. You get these £90 right away, which allows you to produce more breads and have a couple of extra customers that you can satisfy here, right? So you sold them for less than what they're actually worth, but because you got your money quicker, you got the ability to fund your business faster. This is the whole thing that we're talking about. The aim of raising money is that we're setting you start for retained profits, but that way you can live more quick. Now, the guy who bought this, with the hat here for the finance guy, the guy who bought this is happy because he makes a £10 profit. The only thing he has to do is wait. He just has to wait until the end of the month, and the money is gonna come direct to him. He has incoming of 100. He has paid 90, so he made without actually doing anything, just by making the money available, he makes a nice profit every month. Of course, he assumes the risk of default. I mean, that depends on the type of arrangement you default, but he assumes the risk of default. If you're selling your bread to schools and stuff, and their funding is secure, they're gonna pay you, it's fine, it's on the way. If you're selling your bread to kind of market stall holders all over the world that, some of them might not turn up to pay, and there's a higher risk involved, then you will assess how much risk it is that some people are not going to pay. In that case, maybe you would purchase this battle here, this invoice, it's for 85, right? So you got an additional profit, and the additional profit covers the chance of any loss. Yeah. That's one way This is called factoring or invoice discounting. Is a common way for people who have got regular incoming streams of money to realize these streams of money quickly, not wait for the date on the invoice. Same logic as we were presenting here for the mortgage-backed securities and all of that stuff. Instead of waiting every month for every homeowner to pay their mortgage, you bundle them, you sell them, you get the money right away, so you get like a whole stack of money that you can do stuff with more quickly. There are other things, right? Other types of leases that you can raise money. You hear sometimes about hospitals doing this, institutions that have got a lot of equipment, right? What if you've got a business that requires a lot of expensive equipment? So you have bought all this perhaps, maybe you've got the entire hospital here or there. And you've got all sorts of equipment, let's say, that you need in order for the doctor to replicate it involved. But you need to raise additional money. What you could do, if you need like a big bag of cash, all of a sudden, you could sell all your equipment. So these are all your X-ray machines and so on. You sell it to the finance company. The finance company gives you all the money. But you sold it when you transferred property, you still have the machines. You still have the machines and create now the machines that demand. So you generate a stream of money that goes to the finance company, but the finance company has given you a bundle immediately that you have used to hire more doctors. Where the hell you gotta find them, I don't know. For other reasons, but anyway, you hire more staff, you build an extension to the hospital, right? So you've done all that. So this is another way that you can generate cash in order to do things. You have sold and leased back your equipment. So now you've got the monthly payment that goes out, but you've got a huge bundle of cash at the beginning that you were able to realize in the future. That seems like a clever arrangement. It is a clever arrangement so long as the cost is contained. The problem is, a lot of these sale and buyback transactions happened during the 2000s, when the government cut the funding, because the government decided to screw the poor people. So they engaged in kind of 10 years of unnecessary austerity for fun. And then because all the institutions are out of money, but they already had the equipment and the buildings and the stuff, the only way that they could keep operating was by engaging in these arrangements. And most of these arrangements were with friends of the government who ran all the big finance companies and so on, that they looked great, but they actually charged extortionate amounts of it. So now you're in a position that the mines are now in the hospitals and the schools and all that stuff cannot make their payments. And a year ago. And that's why the government now has stopped the various private finance initiatives and the various selling leaseback agreements and all of that stuff because they realized the liquidity damaging. But that's, that's a story for another day. But it is a valid way to raise money. Now, whether you should be doing it or not depends on what's your expansion plan. What are you going to do with the money that you generate originally? The interest, can you meet those repayments? What is the overall impact to your business? What is the sustainability of this lending voyage? Yeah. But, so the mechanism is not bad. The cost of it is what you should think about.